80% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We are seeing in certain pockets, like manufacturing, their supply, they're seeing price pressures. But what they're not doing is planning on passing much of that along to their consumer, to their end customer. So I think it's the inflation story is complicated. Our goal is to have it hit above 2% this year. Our forecast is around 2.1%, but we don't see it running out of control.
The constructive view from Patrick Harker, the Federal Reserve Bank of Philadelphia president, from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz out of the building. Here's the price action this Monday morning. We looked like this on the S&P 500. We pulled back after a week of gains and a huge move higher into the close on Friday. This Monday, we're down about 0.4% on the S&P. The euro softer. Euro dollar still with a 117 handle at 117.78. Into crude we go. $60 and about 70 cents, down 0.4%, and yields in a couple of basis points to 165.67. So we're a little bit defensive just to kick things off this week, Tom, going into payrolls a few days later.
Yeah, and as you said, a little offensive, folks. I'm watching the VIX off the Standard & Poor's 500, 20.10, and where that is because of that huge pop-up we had on Friday, and Marcus Ashworth, of course, linking that in to you got to get rid of that stock, and you got an index on the other side, so everything goes up as you get out of these selected securities. We're going to digress right now. We are focused on this story. Well, we've got a great hour 7 and hour 8 to come up on the Margin Call News. But right now in Washington, Emily Wilkins joins us. We're thrilled she could be with us today. Emily, what's really beginning to shape up here is Everett Dirksen, not billions, but trillions and trillions of dollars of new spending. We saw the Democrats ram through the stimulus legislation. Can they do the same thing with infrastructure?
That's what they're probably going to be trying to do. With this larger infrastructure package, we expect President Biden to start laying out exactly what he'd like to see in it this week. Wednesday, he'll be in Pittsburgh making a key speech. He's going to focus most of that speech on infrastructure, and that's sort of the part of this bill that could potentially be bipartisan. Remember, the idea is to break it up into chunks, perhaps do one bipartisan chunk with roads, highways, broadband, things Democrats and Republicans agree on. And then next month, we expect the president to go a little bit more into other aspects of the plan, including climate change, health care, child care. And that might be in a different package that Democrats have to use that budget reconciliation process to pass by themselves.
Is anybody going to pay for this?
That's the huge question right now in D.C. I mean, that's what we're looking at the Biden's tax plan for, that could potentially provide some revenue to cover part, perhaps not all, but part of this spending package. And then, of course, there's a question, how much debt do we want to take on? That's been a huge argument from Republicans as to why they did not back the last spending package. And it could come up again as to why they might not pass this next spending package.
Emily, forgive me for asking for some more details on the timeline and to offer up the timeline question, but what is the timeline?
So I think we can kind of think of Wednesday a little bit as the starting gun. We've been preparing, we've been stretching, discussions and negotiations have been ongoing, but Wednesday is actually when President Biden is going to pivot the messaging from the previous COVID package to this larger infrastructure package that could be as much as $3 trillion. From there, we're going to see Congress get underway with hearings, markups, trying to sort of work exactly what can and cannot be in this package, making sure that they have unified Democratic support, which is absolutely huge here because they can't pass anything if they don't get at least 50 Democrats on board. I think we're expecting to see negotiations go throughout the spring, throughout the summer, and then around September, I think, is the timeline that we're looking at to make sure that something gets done, because there are a couple critical deadlines in that month that lawmakers need to meet.
Let me give you another deadline. This economy is set to boom. And Tom, I think that's a story too, that to get more through down in DC, you need to get it done before you start seeing this economy booming, because the appetite to do it might quickly wane. Look at the estimates for Friday. We touched on it. Let me do it again. Bank of America, Michelle, good friend of this program, 1 million. Lou Alexander of Nomura, 950K. These are payrolls estimates. Michael Gapin of Barclays looking for 900K. Tom, these are big numbers, and this is just the beginning.
Well, it's just the beginning, but Emily, okay, let's go there. I mean, does the politics really link into what we see at Bloomberg and economic data? I don't buy it for a minute. They're on a mission.
I mean, you did see with that last spending package, the $1.9 trillion, that number didn't change. Even as you started to see the economy get better, you started to see more people get vaccinated more quickly. I mean, part of this rests in campaign promises that the Biden administration feels that they need to make sure they're keeping to Americans. Remember, Democrats have a very tough 2022 midterm election coming up, and they want to make sure that they've been able to physically deliver something for the American people. And I think that they're thinking in broader terms of something that's more long-lasting than just that last stimulus COVID-related package we saw.
Emily, I want to sit on some good news and not let it slide. Let's not let it pass us by. We had more than 3 million vaccinations in the United States of America on Friday. The 7-day average now over the last 7 days, the daily average is 2.71 million doses per day. When do you expect to hear more from the CDC, from this administration, about what vaccinated people should be able to do, considering the amount of vaccinated people in America is quickly ramping up?
I think we can absolutely expect some updated guidance from the CDC as a larger and larger percentage of Americans have been vaccinated. I mean, you already heard the CDC weigh in and start saying, okay, if you have a bunch of people who have been vaccinated, it might be okay for them to gather together, a small number in a smaller space. And so you are hearing those updates come through as we are seeing more and more vaccines come out. Of course, there are questions about making sure that vaccines are meeting the people who they need to meet, that there aren't individuals or groups of individuals being left behind. So I think maybe if you sort of get down to the nuts and bolts, there's still some more fine tuning that needs to be done in making sure that the distribution process is going well. But at the top line, we're definitely seeing increased numbers of individuals being eligible to get vaccines and being able to receive those shots.
Emily, thank you. Always good to see you. Emily Wilkins there, down in DC of Bloomberg Government. Tom, it's easy to get sucked into the latest noisy story. Last week, it was a big boat stuck in a canal. This week, it's a hedge fund blowing up. But the underlying trend is something we have to sit on and not let us pass it by. The story in this market right now is reopening. The amount of vaccinations we saw on Friday in America was absolutely phenomenal. The daily average now, as I say, is 2.71 million. And this Friday is when the data starts, when we start to see these big numbers, at least in the eyes of economists. The estimate right now, median, 643,000. And the range, we're looking for anywhere up to 1 million. And we're going to see a lot more of this, hopefully, in the months to come.
It's something we're not focused on today, John, but it does bear mentioning. In the week that I was away, the gap between COVID in Europe and COVID in America, if anything, it widened even more. As Miracle, I mean, I know Miracle's headed out the door, so maybe she's more vocal, but she was stunning and chastising her nation about getting the foot off the emergency brake.
And the push at the federal level. Big push coming now in Europe. There needs to be. We need to close that gap on the continent. Tom, a lot to get through. We need to focus on that hedge fund blowing up too, so let's do that right now. Look at the equity market. Equity futures come in just a little bit. Now, a lot of was made of this over the weekend about the open we might see. Well, this is where we stand right now. It's calm, Tom. We're down 0.4%.
Yeah, it's calm.
The bond market yields are in a couple of basis points at 165.67. Right. So we need to talk about what was on the long side. We need to talk about what was on the short side. And Tom, what else is there to unwind?
Well, we're watching the headlines right now. We've heard from Nomura. We've heard from Credit Suisse and Goldman Sachs. I haven't heard from Morgan Stanley, John.
We'll hear from RBC up next with Gerard Cassidy, the bank's analyst, on what is turning out to be a bank's rout in Europe. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance. Alongside Tom Keene, I'm Jonathan Ferro. Here's the price action this morning. Let's keep things calm. We're down about 0.4% on the S&P 500. On the Russell, down by 0.7. On the Nasdaq, off by 0.2. After a big move higher into the close on Friday, we managed to push out a week of gains. We've got to do a couple of things. We've got to talk about a big hedge fund blowing up, Archegos. Can we call it a hedge fund? We'll call it a family office. Let's talk about this a little bit more carefully and meticulously. Not just on the long side and what had to be covered, but what was on the short side as well. And maybe that had something to do with that ramp into the close on Friday, where basically the S&P 500 and elsewhere went vertical. We'll touch on that in just a moment. Switch up the board into this. Let's look at the banks. Credit Suisse, Nomura. What is it about Credit Suisse and Nomura that took so long to unwind some of this? Were they too slow? There's some questions we've got to ask, because they could see some real losses off the back of this. In their own words, we're down round about 13.7% on Credit Suisse. On Nomura, over in Japan, down by 16%. We'll touch on that again a little bit later. Once again, there are questions we need to ask, and questions we need to ask of the right people. We'll do that with RBC's Gerard Cassidy in just a moment. Outside of this story, which will get all the buzz through the morning, and rightly so, you've got to stay on top of the big theme. So let's finish on this in the bond market. 2s, 10s, and 30s. Yields in 2 basis points on 10s to 165.49. On 30s, we come in by a couple of basis points to 2.3577%. So bull flattener. Mild defensive positioning just coming into Monday. Nothing major yet, Tom, but I wanted to sit on this because I do want to keep going back to the main story, which will dominate the week, away from the buzzy story this morning, which is the amount of vaccinations in America. Amazing, north of 3 million Friday, a daily record. The daily average over the last 7 days, north of 2 million, well north of 2 million, approaching 3 now. And also the data, this Friday, payrolls is set to be massive in the estimates coming from economists that we survey. And Tom, this could just be the beginning.
You've got to really believe we'll be unwound by Friday here on this margin trade, but it's something we're watching, and we've got all sorts of people to give us wisdom through the morning to explain the complexity of total return swaps and, of course, the complexity of losing billions of dollars. If you are a black bear from Maine, you get a job in accounting out of the University of Maine. 40 years ago, that's what Gerard Cassidy did. He is legendary at RBC Capital Markets, and we are thrilled to get his perspective, because in my Rolodex, he's the only one that remembers the collapse of Continental Illinois out in Chicago. Gerard, let's cut to the chase. You and I have seen this before. Why is this debacle of this hedge fund different?
Tom, thank you for having me on the program. And I would say first, it's the size. I mean, this is an enormous size hedge fund when you put it into perspective over the last 30 years. So when you think about long-term capital and what happened to them, and back in the late 90s, you might remember, they weren't as large as what we're just seeing from this one situation develop on Friday. And so to me, that's the implication, is that, we allow or companies grow very quickly into the billions of dollars, right, and they get very large amounts of leverage. And as you know, leverage leads to problems when asset prices move very quickly.
We've seen this lesson so many times before, and again, the leverage is extraordinary. Gerard, what does a bank actually do when this event occurs? What's happening this morning for Mr. Gorman? What's happening for the leadership of Nomura, the new management at Credit Suisse? How do they unwind a trading debacle, a prime brokerage debacle like this?
Well, hopefully, Tom, that the assets involved that have to be liquidated aren't very illiquid, because the more liquidity that these assets may have, the greater the losses will be. We'll find out more this week as this story unfolds, what exactly happened here. But the first thing that these, obviously, management teams will do will go to seize collateral, they'll liquidate positions, and then, unfortunately, in some of these cases, you're going to see losses, as I think Nomura may have already announced, as well as Credit Suisse. So the first thing they do is seize the collateral, liquidate the account, and then follow up, hopefully, by seizing other assets, if there are any other assets that they're permitted to go after to cover those losses.
Gerald, I'll try and phrase this delicately, because some of these banks don't fall under your coverage. So let's keep things as general as possible if I can, so you're able to comment on them in detail. What would it be that would take, say, a couple of banks to face significant losses and a couple of other banks that seem to say it's immaterial? Would it just be the size of exposure, or is it something about the way they handled it when things started to blow up?
Jonathan, I think it's both, but your first point is very well said, the size of exposure. So that to me is probably going to be one of the real distinguishing factors between companies that have immaterial losses versus multi-billion-dollar losses. But second, it's also the controls and procedures and the level of skill and experience of the people involved in handling the account. And so you may have people that have 15, 20 years of experience handling this account and therefore can move quicker or see the signs more clearly than an inexperienced person.
Well, let's talk about this account. There's something about this particular account that generated a lot of competition, a lot of demand to have this client on the books, Jared, and that includes Goldman Sachs. And our latest reporting saying that compliance basically rejected this client again and again and again, and then something changed a couple of years ago. Jared, what's your take as an analyst to hear that this morning?
That's a little disturbing that, you know, when you hear about an account opening that has been rejected more than once by the compliance department and eventually they do get to open the account. It obviously shows how aggressive certain companies are in trying to, you know, win new business. Obviously, to grow their business, you grow with existing customers. We all know that. But also adding new customers in to the fold is very important as well.
Gerard, a question, and I don't want to get you in trouble with RBC, but I think, you know, we've known each other long enough where we can ask this for our audience worldwide. The heart of the matter is a meeting where a manager says, we're number 4 in blah, 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 and we need to be number 2 by September so we can bonus out and keep our jobs. Isn't that the heart of the matter in this repetitive reality of too much leverage leading to difficult losses?
Tom, I think that has a real influence on it, no doubt about it. The so-called league tables, which are more in the investment banking area than the trading area, but these companies do pride themselves at being at the top of those tables. And I know when you look at the big broker-dealers here in the United States, clearly they're not going to be happy being at the bottom or the lower portion of those tables. So there's that pressure there, no doubt about it. I don't disagree with you.
Would you change buy, hold, sell on Goldman Sachs or Morgan Stanley?
Not on this news alone. You know, this comes with the territory, and it sounds kind of glib, but it's truly the case because when you think about what they're doing every day, this type of risk is there. And if you have the controls and procedures in place to mitigate the risk, which again, we'll find out if that's the case, and we'll really could separate these broker-dealers like a Morgan Stanley and Goldman from the others. If they are exposed and there's minimal loss or no loss, then that's obviously sets them apart from the people that took sizable losses.
George, you know what question will be asked though this morning? One of the many questions is just how many Bill Hwangs are out there right now. Yeah. And if you're overseeing the prime brokerage unit of any of these banks that fall under your coverage, what do you think they're doing right now? We're doing a full-scale reappraisal of every single client on the books. Are we looking for more Bill Hwangs out there that we need to actually trim exposure to?
Jonathan, I think they're definitely going to do deep dives to make sure that their books are in order. As you pointed out, they want to make sure that, you know, there's not exposures like this to other customers. So you're right, there will always be. But I would also point out they do this regularly. You know, it's not one and done. Yeah. So they're constantly monitoring their prime brokerage accounts. But maybe a more in-depth review is warranted considering what happened on Friday.
Jared, it'd be rude of me to let you go without getting your top pick. What is it right now?
Jonathan, we're pointing to Bank America. I think you guys talked about how strong the vaccinations were on this past week. Also, the employment numbers coming out on Friday, which means this U.S. economy is really geared up for some real strong growth. Bank America is the best way to play that.
Jared, great to catch up, sir. Good to see you. Jared Cassidy there of RBC Capital Markets, head of U.S. Bank Equity Strategy. Tom, just on the bank side of the story, you see what Jared went back to then straight away from this story? Vaccinations, payrolls, data.
That's true, John. And what is so important here that we've heard from Gerard Cassidy and frankly our banking team here at Bloomberg is we forget the mass, the scale, the size of these banks. Yes, Goldman Sachs and Morgan Stanley, maybe not like JP Morgan and as Mr. Cassidy mentions, Bank of America, but we forget the scope and scale where you allow a Nomura in the final 2 sentences of their press release, I believe it was yesterday, where they say we can withstand this based on our tier 1 ratios.
Yeah, and I imagine Credit Suisse is saying the same thing, but both banks, Tom, are also saying they face potentially significant losses from this, and we still don't know what the numbers are.
Well,
so this morning, I think it's what we're grappling with, right? How big was the exposure? Not just the banks, but how big was the positions of this particular fund that has blown up? The other thing we're grappling with is what's left to unwind. We still don't know.
Well, we don't know, but John, I liked your question to Mr. Cassidy, the idea of what was the edge that it appears Goldman Sachs and Morgan Stanley have, and sometimes that's either information or it's outright courage where somebody just says, pull the trigger, take the immediate loss instead of the larger loss later, and I'm sorry, that's courage on a trading desk.
Well, they're the questions we've got to ask of Nomura and Credit Suisse this morning, Tom. Why are they coming out with statements that look like that? As Morgan Stanley, Goldman, and others are coming out with different
this is
statements.
critical. This is something, folks, so sensitive, and John and I have dealt with this over the years. Is it geography? Is it that Morgan Stanley and Goldman Sachs are in New York off of 7th Avenue, where this hedge fund is located, and the others are just psychologically distant?
I'm in a privileged position to offer the simple answer. I don't know. I don't know, but I do think you raise a good point, Tom. The other issue we need to get to as well is just the competition for this particular client. And our colleagues Eric Schatzker and Sri Natarajan have really led the reporting on that. Why at Goldman this client was rejected by compliance repeatedly,
oh, come on. It's just
and then something changed.
It's just the revenue coming in with this guy's a hitter, and I don't mean this specific hedge fund, but just always the idea in prime brokerage that you want to get. I mean, John, watch Billions.
You use the word greed, though, Tom, and that's what people are discussing this morning. How pervasive is it? How much leverage is being used out there?
It's timeless.
To drum up some of these rallies.
It's timeless, and the only way, John, and frankly, the British do this better in their own strange way. There's a point where government has to step in and say, you can't build up these positions.
Coming up, we'll get back to one of the major stories outside of this one. Joshua Sharfstein, Johns Hopkins Bloomberg School of Public Health Vice Dean, on vaccinations in America. North of 3 million on Friday into the weekend. Just phenomenal numbers.
Big number. Big
phenomenal.
Number.
Equity futures down 0.4%.
I can see you.
Go on, Tom.
I can see you without a tie. I mean, I think
if you keep
it works.
the beard, I'll lose the tie.
Okay.
You haven't mentioned Gareth this morning. We're 40 minutes into the show. What's going on?
I think it works. I mean, Pharaoh without a tie is sort of like a young lad. A young lad thing.
A young lad. The burden of youth.
God, the Spurs, thank God they won while I was gone.
Welcome back, Tom. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. 6 days after that giant container ship got stuck in the Suez Canal, salvage crews had good news to report. The ship has now been partly refloated and the operation to free it completely is continuing. Still no word when the canal will be open to traffic. The blockage had led to a backlog of hundreds of ships waiting to pass through. The Biden administration isn't ready to end tariffs on Chinese-made goods in the near future. The U.S. Trade Representative Catherine Tai told Dow Jones that tariffs can hurt American businesses and consumers, but she also said they can protect companies from subsidized foreign competition. And in China, ride-hailing giant Didi is raising new funds for its self-driving unit. Bloomberg's learned that Didi Autonomous Driving is seeking up to $500 million at a valuation of roughly $6 billion. The company is trying to boost growth ahead of a planned IPO this year. In Minneapolis today, opening arguments are set in the trial of the former police officer accused in the death of George Floyd. Derek Chauvin was seen in a videotape kneeling on Floyd's neck for more than 9 minutes last May. Floyd's death sparked protests across the U.S. England is taking a much-anticipated step towards exiting its lockdown. Starting today, 6 people or 2 households can gather outdoors. Plus, outdoor sports facilities such as tennis and basketball courts will be allowed to reopen. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It is conceivable that you'll have a good degree of flexibility during the summer, even with the children, with things like camps. We don't know that for sure, but I think that's an aspirational goal that we should go for. I would expect that as we get through the summer, late spring, early summer, there's going to be a relaxation.
I would suggest that some of these officials get out to New York City and see what's already happening. The rest of the world, never mind relaxation. This city was buzzing over the weekend. That was Dr. Fauci on CBS over the weekend. From New York City for our audience worldwide, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Here's the price action. We look like this Monday morning. Your S&P 500 pulls back by about 13, 14 points and down a third of 1% in the bond market. Yields in a couple of basis points to 165.31. In foreign exchange, euro weaker. Dollar slightly stronger. Euro dollar 117.69.
John,
and Tom,
there's
crude
stability.
up 61.36. I used the word earlier. Stable, with just a bit of a defensive posture.
Yeah,
to kick things off Monday.
I mean, you were here. I was off on sabbatical, but we saw that pop on Friday, and we've had guests link it to these margin calls. Do we expect a pop today when new block trades come in?
It depends what's left on either side of the book, Tom, and I've got no idea.
Yeah,
I've got no idea. I bet you that if we see anything gappy, people will draw a line straight back to the events of the past week.
My roulette wheel here, folks, this morning is a VIX 20.04. Maybe that should be 21.22 if there was some real angst. But we are going to continue to talk to experts across global Wall Street as we talk to experts on, as John mentions, the good news of the recovery from this terrible pandemic. Joshua Sharfstein has been wonderful with us over the year. He joins us now, the Vice Dean of Public Health Practice and Community Engagement at the Bloomberg School of Public Health. Dr. Sharfstein, what I have noticed is there must be a constraint. John mentions 3 million, 2 million, whatever vaccines. And to me, it is the volunteers and the nurses and staff actually with syringe in hand. Is that the real constraint we have in getting this vaccine out ever more?
Well, right now it's still a supply constraint. They're, waiting for the new doses to come rolling in. I think there are a lot of potential volunteers, and if it's well planned, I'm sure the U.S. could deliver even more vaccines every day. At a certain point, though, we will exceed the number of people who are so eager to get a vaccine, and it's going to turn into a longer battle of getting vaccine to people where they are.
Do we need to resell that now, the campaign? I think of the courage of Dolly Parton out front, I think she's 59 and holding, but, Miss Parton was out with a lot of images 2 weeks ago or so. Do we need a campaign now to get us out to the need in May or June?
Yes, I think that that is starting to happen. I love Dolly Parton's message, and there are others out there. I think we'll start to see more coordinated efforts, and not just one national message, but targeted messages to different communities that really explain the value. And of course, this is a vaccine that sells itself, because people who are vaccinated and have done well will tell their friends about how much better they're feeling.
Joshua, I just wonder from your perspective, and I think you're in a better position than me to tell me what's going on right now. Why hasn't New York, one of only just a handful of states right now, announced plans to widen eligibility to everyone 16, 18 plus in this state?
Well, I'm sure that will happen. I think they're just working through the fact that they have so much excess demand within the groups that they've set already for the vaccines that they have. I think the White House made a really smart move by saying, look, we'd like to see it by May 1st. Giving states time, but also sending the message, we really need you to scale up. This supply is going to be there. Don't act surprised when suddenly you have so much vaccine that you really need to open up.
Could you help me understand the amount of guessing that's needed to actually understand the acceptance issues that we need to try and anticipate, Joshua? Is that just a guess going into the next month? Because right now we know we can do more than 3 million vaccinations a day. And if we drop off before the bulk of this country is vaccinated, we also know that's an acceptance issue. So we need to try and get ahead of that. My question, Joshua, is how?
Well, right now they're seeing vaccination acceptance issues in different parts of the country where there are a lot of open vaccine spots in different states. There's a lot of research that is being done to understand vaccine acceptance for the COVID vaccines. And what it looks like is there's a big group that really wants the vaccine. That's why we're seeing such high numbers. Then you have a relatively small group that is really, really deeply skeptical of the vaccine. And a lot of people in that group, are open to hearing a little more, but right now they're thinking no. And then there's a larger group in the middle, maybe even 20, 30, in some places 40%, who are in the wait and see group. And they really want to see what's going on. They still have questions that need to be answered. And the first task is to make sure those questions get answered, do a lot of outreach, and put vaccines close to people like that.
My amateur take on this, Joshua, is this is always the case, whether it's antibiotics years ago or bacterial, viral solutions as well. Again, how do we sell science to people genuinely concerned or mystified by this powerful science you and others are doing?
Well, I've done a lot of events with all kinds of different audiences, just answering questions, events with mayors. I was with the mayor of Lincoln, Nebraska, events with frontline workers, answering question after question. And, I think that it really helps. There was a great story in the New York Times talking about how rates increased among nursing home workers who were skeptical. And, they tried to show like famous people giving messages, but what really mattered was sitting down with people, hearing their concerns. Here's why the vaccine came about so quickly. Here's all the research that it's based on, which is really quite considerable. Here's what we know about side effects. Here's why so many physicians are getting vaccinated, because they know how serious this disease is. And when people ask questions about unknowns, well, what could it do in 10 years? What could it do in 5 years? Of course, we don't have that kind of experience. You have to explain the science behind the vaccine and why it's important to, why it's possible to feel confident, but also compare that to the unknowns of getting COVID and the long COVID syndromes and all these very serious issues people are facing, and say that's the real comparison.
But Joshua, the big issue right now for many people to get them over the line to get a vaccine, beyond everything you've just said, which is all valid and on point, and I agree with you, is just telling people what they can do if they've been vaccinated, and we still haven't done that sufficiently. We've basically told them, Joshua, they can gather in a room with other vaccinated people. Most of the country's already doing that.
Well, I think that is going to change too. And I think we're going to see businesses particularly saying that, they'd like to see vaccinated people, for certain types of events, for example. And I think that it's going to become more of a norm. But you can't, I don't think, start there. I think you start by vaccinating the people who are really excited to be vaccinated and let them be, ambassadors of the vaccine. And then each additional wave of confidence and activity grows, and that reduces the number of people in that wait and see group as they go on to get vaccinated. And I'm starting to see them. I go out vaccinating with the Baltimore City Health Department, and I'm finding people who said, I wasn't sure about getting this, but my husband told me I needed to, my neighbor told me I needed to, my daughter said she wouldn't talk to me unless I got it, and I'm here.
Thanks for the hard work you're doing for this country, sir. Joshua Schaufstein there of Johns Hopkins University, Bloomberg School of Public Health. Alongside Tom Keene this morning, I'm Jonathan Ferro. This is Bloomberg Surveillance with your equity market coming in just a little bit. Stable but negative on the S&P. How's that, Tom? Down a third of 1%. This is Bloomberg.
will start soon delivering also COVID-19 vaccines once all permissions have been granted. We are in discussion with Ministry of Health, with current logistic partners in different countries. So we're looking at Southeast Asia right now on delivering COVID-19 vaccines. We are also setting up already on the African continent in already one country and looking at the second country to expand.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
To be conscious of the fact that the vaccine alone and the COVID story alone does not tell the whole story.
We need to get the economy to recover. We need to get the economy to heal with minimal scarring.
The downside, of course, is higher interest rates, higher inflation, and that's really taking some of the steam and froth out of markets.
People are pricing in success for the Fed in terms of achieving the inflation target.
If we do start to see inflation rise in the United States, there's a very good chance that could be exported elsewhere as well.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Sir, this is a margin call from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Lisa Abramowitz is off today, and we're discussing the forced liquidation of $20 billion worth of holdings, Tom Keene, over at Bill Hwang's Archegos.
Just right across the Bloomberg terminal, Sofia Jorge Acosta with another very careful derivative article, John, as we're all learning about total return swaps, contracts of difference, the way this is done in the hedge fund world, and once again, leverage fails.
How you can build a position in a company in a single name, Tom, without needing to disclose that position because you don't own the underlying. And we'll discuss that in just a moment with Krishna Mamani of Lafayette College. But I just wanted to take a moment to do this. Compare and contrast how this story is being covered this morning compared to, say, GameStop, which led to all kinds of conversations, Tom, about having meetings down in DC and hearings to figure out exactly what happened and whether there is any systemic risk here. Let me tell you, after GameStop, were we discussing Credit Suisse down by 13, 14%, Tom? Were we doing the same thing, talking about Nomura? Were we talking about any of these banks down as hard as they are? Why is it when it comes to institutional investors, we have these sophisticated conversations about what went wrong? But when it comes to GameStop, we need to do something about it.
Well, GameStop is a retail thing. You know, John, you were home on your laptop on the couch trying to make a penny there to pay for the trip to Capri. But the bottom line is the great fear here, John, is these isolated Wall Street events can blow up into a bigger issue. Tracy Alloway and her team in this article moments ago on Bloomberg go back to Anglo-Irish of 2008 that almost brought the financial nation of Ireland down. That's the fear, but it appears that's not happening now.
Well, let's have a hearing on this and work out what went wrong and what we need to do about it, Tom, to make sure it doesn't happen again. This morning, this is what we look like right now on the S&P 500.
We look pretty good.
Futures come in, 1/3 of 1%, no drama here. Mild stability, yields come in a couple of basis points, 165.14. In the FX market, euro dollar 117.69, and crude 61.48. That's the broader asset class story. And Tom, the conclusion to the question I posed just moments ago, you can't avoid these kind of things. They happen periodically, these big blow-ups. This morning, of course, we asked the obvious question, how many Bill Hwangs are out there? What's left have to unwind? How big was the position?
Yeah.
Because we still don't fully understand the answers to those questions.
Well said, and I really want to make clear in my reading, and folks, most of us have been up most of the night here as the news is breaking out of Asia. John, this is not 1998. This is not LTCM, where it became very systemic and all of Wall Street had to deal with it. Right now, at least, this feels very compartmentalized. What I would suggest, John, is I'm waiting to hear from Morgan Stanley. We haven't heard from them yet.
We haven't heard from the big banks with the clarity we would like to hear from them either, Tom. I think there's some big questions that need to be asked the Credit Suisse of Nomura, and I'd like to see the executives of them out there talking about exactly what went wrong. Krishna Mamani joins us now, Lafayette College CIO. Krishna, we'll start with an easy one. Your take this morning.
Well, so, this is an unwind of a levered position. I think in this sort of an environment where we have had the sort of run in the market that we have had, it is tempting to kind of transform it into a catastrophic, financial market-wide situation. I don't think that is the case. I think this is very specific, related to one set of positions and one type of name. So I think this will blow over in a couple of days.
I agree with you. I agree with you so far, Krishna. That's what it looks like. And I do think we have to attack this calmly and specifically and meticulously. Doug Cass writes in and says the following: we too often mistake leverage for genius. Krishna, I just wonder, how much leverage do you think is out there right now, and whether we're mistaking the price action of the moment and tying it back too much to fundamentals when a lot of what we've seen could just be driven by massive leverage?
Well, so, I think leverage in the marketplace is nothing new. Leverage right now is probably higher than it has been, but I think that is probably driven more by, significant amount of retail participation than anything else. That, nobody liked equities for a long time. So the positions in the marketplace were more professional positions. Now there are more individual and retail investors involved. So leverage as a result is higher. Having said that, I think we kind of tried to put too much onto the leverage. If there is a significant uptrend in growth, even with leverage, markets can do well. We have seen that before, quite frequently.
A name you may not know in America, Shuli ran writing for Bloomberg early this weekend. She wrote a different article right now. This is a superb essay, and it goes, Christian, to the leverage that you were not allowed to do over the years at Oppenheimer. Shuli ran, Wang is representative of, not distinct from the rest of the hedge fund crowd. His bets are also their bets. U.S.-based long-short hedge funds are still 201% leveraged, only 9% lower than January's decade high. The ultimate culprits are crowded trades, be they in short or long positions. Krishna, this redounds back on the confidence of investors in the conservative buy side, which you represented for decades, and now you handle at Lafayette College. How does this redound back on confidence for institutional conservative investors?
Well, so I think what this is pointing out more than anything else is certain parts of the market, certain specific securities did very well, much better than they should have done because of these leveraged positions getting built over the last, let's say, 9 months. But I don't think this is really a system-wide problem. Leverage is higher for sure. When debt costs or financing costs are relatively low, you would expect leverage to be built up. But even for conservative investors, I don't think it's problematic. And I think for conservative investors, over the last 3 months, for example, they are seeing their position play out quite nicely. And these are not levered positions.
I want to move on, Christian, to the optimism John Farrow's talking about this morning, including a jobs report today. How do you manage right now your allocation given a new boom economy? Goldman Sachs, among others, at 9 or even 10% GDP estimates. How do you change your allocation given the Farrow boom that we see?
Well, so I think two things. First, at Lafayette College, we are long-term investors, so we don't change our outlook because things all of a sudden started looking better to most people. Having said that, I think the story here is still about equities, and it's about global equities. That is, the boom economy in the U.S. is going to be supportive of the equity market, and the superlative growth that we will realize here will benefit the rest of the world just as much it benefits the U.S. So things like emerging markets, which went down because all of a sudden people were concerned about inflation. More importantly, people were concerned about rates rising to 2% or 3%. Those markets suffered. I think those are the areas that are going to do much better if you have a boom economy without significant rise in inflation, which I think is the most likely scenario.
Where and what in EM right now, Krishna?
Well, so EM, it's probably places that have, that haven't done too well. So it can't be China, it can't be really India where the markets are. It's more like South Africa, more like Russia, those places.
Krishna, I look at where we are, and I'm going to go to John Stolfus over at OPCO, who just reaffirmed a barbell strategy of playing both growth and value as well. Is that your strategy now, and particularly with your expertise of international and domestic, or do you go one way?
Well, no. So I think over the last 10 years, a lot of people who did very well being focused on U.S. continue to do that. And I think first part of the bull market, this most recent bull market, EM did very well. Now they feel, I think the EM market suffered. So international is a very good allocation. Valuations are there and quite supportive. As far as value and growth is concerned, I think given the boom times that you're talking about, value is likely to do well, at least for the rest of the year. Whether that is going to be, and catch up to growth to significant extent. Whether that is going to be the case in 2022, in my mind, is debatable. I think this rotation will be killed by another rotation in 2022, 2023.
Krishna, we'll catch up in 22. We won't. We'll talk soon. Krishna Mamani, Lafayette College, CIO. Krishna, good to catch up, sir. Tom Keene, bottom line for you, keep the barbell.
Well, it's a barbell, and, a lot of people rejiggering here away from all this uproar about hedge fund and massive margin calls, a mystery that we will see through the morning here at Bloomberg. But, John, I go back to the dovetail of optimism on the economy. Goldman Sachs rejiggering their first and second quarter look, as you saw Mike Wilson and the team do at Morgan Stanley this weekend. I'd say the zeitgeist right now, John, correct me if I'm wrong, because that, the Motel 6 that I was at out of LAX, I'm sorry, but the Wi-Fi wasn't that good.
Okay.
It wasn't that good.
3 things we need to do, Tom. Let's talk about the data. It's going to be great this Friday.
It's going to be great.
Looking for a really big number. Vaccinations in America, terrific. Second thing, we need to talk about the forced liquidation of $20 billion of holdings over at Bill Hwang's investment firm. Third thing, we need to discuss the beard. For our audience tuning in on radio, New York City and across the United States of America right now, the beard is in with Tom Keene. It's back. I've seen this before, post-vacation. I'm just trying to work out if it stays, Tom.
Well, it's a building. We've got our interns at our call banks. You can call in now, folks, if you'd like. But, we started out a little light. But, the score has shifted to keep the beard 157
All right,
to
let's
1.
do this.
It's building
let's
out.
do this. This is just for you. Tie's coming off.
Very good. I like it.
So I'll put this back on for the 9 o'clock show.
No, I'd put it. No, John. I'd put it on Tuesday.
No, Tie's going to stay on for the 9 o'clock show. At the open, we'll respect the market open and we'll keep the tie on. I'm going to have no tie on this show for as long as you keep that beard.
If we went and saw the Tots, which, I think we're scheduled to do in our celebration back to London, this is what we'd look like to go see the Tots.
Put it here. Does that work?
Yeah, that works. Yeah.
Does that work? Do you like that?
Maybe. I don't know. On radio, folks, right now.
I reckon that your beard is gone tomorrow. That's my bet.
That would be.
I think that
would be a very
tomorrow.
good record. As you can see on radio, you can reckon the beard will be gone.
Coming up
tomorrow,
8 a.m. Eastern. The next hour, Matt Britt, Invesco head of North American Investment Grade and senior portfolio
they'll love the
manager.
Beard.
I bet equities down 1/3 of 1%. Sounds like Mrs. Keene does too. Yields in a couple of basis points. Your 10-year 165.14. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. It's the first step towards reopening the Suez Canal. The giant container ship that's been blocking the water has been partly refloated. The operation to free it completely is still going on. There's still no clarity on when traffic in the canal can resume. There's a backlog of hundreds of ships. President Biden will divide his next government spending push into two programs. The president will outline a plan focused on infrastructure and jobs this week. A White House spokeswoman says the second proposal would focus on childcare and healthcare programs that will be released in April. In Myanmar, it was the deadliest weekend yet since the military coup in February. Dozens of protesters were killed in battles with the military and the police. One human rights group says at least 114 people died on Saturday, including some who weren't taking part in demonstrations. That's drawn condemnation from governments around the world. And a big boost for Boeing and its 737 MAX. Southwest Airlines has added 100 firm orders for the jet. It also has options to buy 155 more. Southwest will get the first 30 of them next year. The airline just resumed flying the MAX this month after the plane was grounded following 2 fatal accidents. Southwest is the largest MAX customer. Also in aviation, a takeover in the jet leasing business. Carlyle Aviation Partners has agreed to buy aircraft leaser Fly Leasing Limited in a deal with an enterprise value of almost $2.4 billion. Carlyle Aviation is part of the Carlyle Group's global credit platform. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Friday, a Bloomberg Television exclusive, a conversation with Baidu co-founder and CEO Robin Li.
We're far from done. We will continue to invest for the next 10, 20 years.
Watch the full interview only on Bloomberg Television.
Hello traders, it's time to place an order. I'm looking to sell short, open new positions, short position on Japanese yen, and I'm looking to sell short at 109.610. Where is Japanese yen? Here. Price I'm looking to sell 109.610, just right here. So if you're up to Japanese yen, if you're looking to trade Japanese yen, here is your time, here is your chance to enter the trade. So please follow this trade and please enter
your equity market on the S&P.
This order to your
moves. We're down a third of 1% on the S&P. In the bond market, yields come in.
What can I say? Add this order and we will see basically how long it will take us to execute, to fill this order. And I'll speak to you later. I'll let you know how long it will take for us to collect the profit. I'll speak to you later, guys.
For the broader market this morning, no stress for single names for the banks. Credit Suisse over in Switzerland, Tom, in Zurich, down by 13.8%. Brutal moves there.
John, let's take 15 seconds about the anticipation this morning. A block trade of Viacom, maybe through Morgan Stanley. What the billions number there is, we don't know. And you've got to look for debris from these other prime brokers as they unwind this busted trade.
Operative phrase there that you used, Tom, we don't know. And still a lot we don't know this morning.
Yeah, there's no question about that. We'll monitor through the day. We've got a terrific 8 o'clock hour with some experts there. Kevin Cirilli.
Okay, guys, position opened, as you can see, on Japanese yen, short position, just right here. So, great. Let's see how long it will take us to collect the nice profit. Well done, guys. All of you who've tried to enter position, well done.
Previous administration considered and did ultimately issue WROs pertaining to cotton in the Xinjiang province. This is just another textile and another commodity coming out of China that the United States feels that they will be able to put pressure on. But whether it's polysilicon or whether it's cotton, the Xinjiang province and particular regions in China are going to have to be facing a lot of pressure from the global commodity. At the root cause of this are the Americans pushing that and raising these serious concerns.
I think, Kevin, right now it's hard to overstate how serious what is happening. This came from The Economist over the weekend. Let me read you just a quote from it. The US and China's Communist Party are strategic and ideological competitors. CEOs have to decide which side they want to help win. Do you see a push here domestically in America to push companies to make that decision?
Yes. Absolutely, 110%. And I think that as this continues onward, I think whether you're talking about textiles, whether you're talking about metals and rare earth minerals, or whether you're talking about human rights abuses, I think that there is now a push. You know, last week, on Friday, I spoke with Congressman Brendan Doyle. You all have interviewed him, and he is one of those lawmakers, a Democrat from more moderate, but now tending to lean more towards the left, but he also, you know, spoke out and against China on a host of all of those different issues. And I think from a manufacturing perspective, that's really where I've noticed in my reporting the biggest shift over the past 2 to 3 months has that been on the manufacturing front. Republicans and Democrats see an opportunity to boost manufacturing jobs by putting pressure on China.
Kevin, thank you. Important conversation. Kevin Cirilli, Chief Washington Correspondent and host of Sound On Bloomberg Radio. No doubt continuing this conversation weekdays at 5 p.m. Eastern. A really serious conversation, Tom, about the future. Well, multinational after multinational has needed a presence in China, in the mainland, and now it's getting increasingly complicated to carry both positions.
And Kishore Mahbubani, the giant of Singapore, John, really emphasizes this, that this is going to be the huge tip point, is how does business respond now to the new China versus how businesses responded over other regimes in Beijing.
And what will consumers demand from both the United States and China? We got a flavor of the Chinese side, Tom, from the Chinese population, from the Chinese consumer base, in a way that I don't think we've seen too much of over the last several years, and I think we'll see a whole lot more of too.
Give you a little heads up. This is the real focus of my reading this summer. I'll have that out here in a couple hours, really thinking about it over the week, John, but really China front and center. And John, what's important here is this margin call uproar this morning. You know what? It's going to go away. Guess what? China's not going to go away.
Totally. The tension between America and the Chinese Communist Party is going nowhere soon. Couldn't agree more, Tom. Equities this morning, the S&P 500. I've said that so many times this morning already. An hour and a half.
It's amazing. I
mean, agree more.
The beard statistics are unbelievable. Vincent
Where are we at now? What's
the
tally? You keeping this beard? What's the tally?
I don't know what we're up to. They're counting it. The numbers are too big.
Equities down 1/3%. Yields 165.14. This is Bloomberg.
model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio, and here's the price action this Monday. The thing with this Monday is you can't really start with the price action this Monday without talking about Friday and the huge ramp into the close. We'll talk a whole lot more about the $20 billion forced liquidation of Bill Hwang's investment firm in just a moment. But you can't just talk about the long side of the book, you've got to talk about the short side as well. And covering the short side, a lot of people drawing the line from that to the big ramp we saw Friday into the close. This morning, equity futures just a little bit softer. We're down about 1/3 of 1% on the S&P 500. The Nasdaq off by 1/10. The Russell down by 0.4%. Romain Bostic, just meters away from me, is going to run through the banks in just a moment. I just want to touch on the banks, have a look at the stock price, and just ask a couple of simple questions. What happened to Credit Suisse and Nomura that did not happen to Morgan Stanley and Goldman? Credit Suisse and Nomura down by around about 14% and 16 percentage points. They're using the words like significant, material losses, maybe, potentially. That's why they're getting hammered. But if you switch at the board and finish on this, Goldman, Morgan Stanley, they're not having the same conversation. They're down 3% and 4%. And Tom, my question's a simple one. Was this just about outstanding exposure to Bill Hwang's investment firm, or something about how they dealt with this?
How they dealt with it.
How quickly they dealt with it.
My experience, John, is how they dealt with it, who was fast, who moved the quickest.
Romain's going to build on this in just a moment. I'm going to finish on this. In the bond market, 2s, 10s, 30s, just look at the yield curve right now. A little bit defensive, it's stable. Yields are in a couple of basis points on 10s, call it 3, similar move on 30s. Beyond this Bill Hwang story, in a couple of days, we'll move on. And Tom touched on that, and I agree. It's like the ship story last week. In a couple of days, we'll move on. We'll talk about the consequences for weeks to come, no doubt. But the real buzz story we'll keep gravitating back to is what is happening in the United States of America that has pushed yields so much higher. It's vaccinations. North of 3 million on Friday, averaging close to 3 million daily over the last 7 days. Phenomenal numbers. And this Friday, a payrolls report with some economists out there looking for payrolls to push something in and around 1 million. That's where the conversation is going to be this week and beyond for months and months and months. With your banks right now, here's Romain.
Yeah, well, let's go back to today's conversation, John. You talk about that Bill Hwang story. Obviously, there's no systemic risk. At least that seems to be the general consensus here. You are seeing the fallout there on the banks, Goldman Sachs, Morgan Stanley, and, of course, Credit Suisse. These are the U.S. listing that you're looking at on your screen. Obviously, doing a lot worse there. Overseas, Nomura also down, of course. Not only talking about the significant risk, you had Nomura, of course, putting off a bond sale as they sort of wait for this to sort of sort itself out. You had another block trade coming out here this morning on Viacom, and a lot of concerns here that the selling still might not be over yet. And then the question is here, we talk about leverage and we talk about just how glorious leverage can be and just how it can make you a fortune. But of course, once it starts working against you, it can really sort of chop you down and very quickly. That's not only only what we're seeing with Bill Wong's fund, but we're also seeing that with the banks, which of course were on the other side of this trade and now are at least holding some portion of the bag on this. Whether that amounts to some sort of material decline in those companies' earnings, we'll have to see. But what we are seeing in the market, and you flip up the board here, is you are seeing people come back into some of those stocks that had been under pressure this morning, on Friday, excuse me, Viacom, CBS, getting bids here. Some of those Chinese tech stocks, IGE and Bilibili, these are again the U.S. ADRs you're looking at on your screen here. They're all getting bids here. Discovery as well, Farfetch, all coming back here. Yeah. So a lot of folks making the bet here, Tom and John, that this is going to be something that is relatively temporary and that the damage will probably be relatively contained.
Romain, CFA 4, level 5, which is the responsibility of a firm as a prime broker. They've got to sell the shares. They do it off their desk. It's called a block trade. Do they have an obligation to inform the public of the size that they hold on their desk?
Well, the short answer is immediately no. In the long term, yes. If it's material, they have to. And I think what you saw here with some of the banks actually coming out, and I guess the way they disclosed it was actually to some people somewhat encouraging. I know some of it kind of came through the back door on people familiar with the situation. But the idea that some of these banks at least sort of copped to it and just sort of made it clear that this is what was going on, I think that actually might have minimized some the perception of the damage here and might have contained it a little bit more had they sort of kept this in the dark, Tom.
Okay, Romain there, and there'll be many other ideas through the morning here.
Thanks,
we'll keep you up to date across all of Bloomberg. Right now, Vincent Reinhart will join us. Of course, his acclaim as head of research at the Federal Reserve years ago in the Greenspan Fed, and now holding court at Mellon as their chief economist and macro strategist. Romain, I'm not going to be inflammatory. John and I are doing everything we can this morning to remain calm about a margin call. You've studied this before and all. Our institutions are steeled there if there's any issue and all that. Our institutions have never had a boom economy. How is monetary policy executed in and after a boom economy?
Well, I think the answer is the hardest thing about monetary policy is sometimes doing nothing, i.e., keeping rates at their low level, keeping a policy accommodated until you're absolutely convinced the recovery has taken hold and you've made significant progress, as Chair Powell keeps talking about, getting to maximum employment and stable prices.
What is the unemployment rate that signifies this phrase, maximum employment?
We're not going there anymore, are we? Chair Powell pushes back against that idea very hard. The idea of maximum employment is interpreted pretty generally. It's not just a single number. Indeed, I think they regret having this summary of economic projections target this one unemployment rate. They look at labor market conditions pretty generally. By the way, that's a problem with monetary policy right now. It's pretty ambiguous. I can't answer what maximum employment is. Jay Powell doesn't want to.
Do you have any idea on what they'd be looking for, Vince, so to speak? What would be on the dashboard of the modern day Fed?
It's a pretty crowded dashboard, and one problem when you have so many dials there on the dashboard, it's hard to orient yourself, and sometimes you make mistakes. Look, it is the unemployment rate, it is the gains in employment, but it's not just the unemployment rate for working age population, it's going to be the underserved as well. It will be Black Americans. It'll be Hispanic and Latinos. They're going to be looking at low-wage workers. They're going to want to see that the economy is inclusive. Janet Yellen won. Janet Yellen's experiment was run the economy hot and see how well you could do with the labor market. And the answer was they got the unemployment rate down to 3.5%. That's where they want to do it again.
One, Vince, because they were conditioned by the previous cycle. And I just wonder how useful the previous cycle is coming out of this particular shock.
I think the answer is that's how you make your mistakes, right?
Yeah.
Previous cycle, we convinced ourselves that you can't generate inflation. Previous cycle, you convinced yourself you can run the labor market as hot as you want and it won't matter. I think the issue is going to be the political economy. If you ask me where inflation is from three to 5 years from now, I think the answer depends on how closely the Federal Reserve is concerned about fiscal policy. How are they worried about big deficits and debt. That's the big issue.
Vince, what would Alan Greenspan do? I don't mean to be, snide about it, but Alan Greenspan looked at the data, looked at the statistics of industry like no Fed chairman ever. He would be looking at the data now of a boom economy. What does he do with his data? What does this Fed do, like Greenspan, with the data that's countable when we boom?
Well, remember that the Fed's new framework explicitly rejects a couple decades worth of monetary policy making. It was monetary policy is made based on the outlook, because if you wait until something happens, you've waited too long. Wrote those sentences, I don't know how many times, but you've heard them, I don't know how many times, Tom. What does Jay Powell say? He's waiting for the outcomes. This is outcome, not outlook-based monetary policy. And explicitly, they want to get the unemployment rate and labor market down, labor market conditions hot. They want to see inflation above their goal for a sustained period. That's when they'll start adjusting policy.
Right.
It's outcome-based. That means you're following, not leading.
Can you model for your Mellon clients wage inflation?
Wage inflation is, I have to repeat Chair Powell again. Wage inflation does follow the conditions of the labor markets. Oh, by the way, though, remember base effects do matter. We have big compositional effects in which it has been, unfortunately, lower wage people who have been unemployed, and that's why average hourly earnings popped up so strongly in March and April 12 months ago. Well, they're going to drop out of the 12-month change, and so you're going to see some people say, "Hey, look at that! Wage inflation just dropped a percentage point. We don't have any problems." Not the issue. Generally, wages do follow labor market conditions. What's much harder to predict is margins. Quite often, businesses take it up into profit margins rather than pass it through to higher prices. However, if inflation expectations rise, if people come to expect inflation, that behavior will change.
Expectations the key there. Vince, it's good to see you, and I'm looking forward to catching up again. Vincent Reinhardt there of Mellon. This is where the story begins this Friday. The data we've been talking about, the boom everyone's anticipating on both the bear side and the bull side, we all agree on what the data is going to look like in the next couple of months. It begins on Friday, and the estimates are there for all to see, Tom. Your median right now, 643. I believe we get the CPI print a little bit later on this month. I believe April 13th, is it? April 13th, I think we get the CPI print for America. That's when the base effects kick in. That's when we start to have this conversation, but a conversation with the data there to see.
And John, American Airlines just out with along the kind of headlines that we're going to see among this good economic data. American Airlines expects to reactivate most aircraft in the second quarter. And this goes, John, back to Ed Bastian's conversation with David Weston about his optimism on getting the United States travel economy back in gear. That's another add-on to this.
And also how the supply side responds too. Mohammed Al-Erin wrote his piece on inflation this morning, which I'm just slowly reading through, Tom. And it's the difference between the cycle and working your way through the cycle and understanding the moment we're about to go through. And a question I've been asking is just how we'll respond to this moment that we're about to see in the next couple of months. You can anticipate the data.
Yeah.
You can talk about how you respond to the data, but when you actually see it, how will you react?
John, Lisa's not here. We need to worry. Okay, John.
What do you want to worry about? Inflation?
We don't know how long it's going to last. We don't. There's immense uncertainty about how long it will last. She does it better than me. She does it better.
She does, and we're looking forward to having her back tomorrow.
The pendulum.
The doom. Coming up. Alberto, rather. Although we can call him Alberto. Yale School of Medicine, Department Chair and Professor of Epidemiology and of Medicine.
Nailed that, John.
Thank you, Tom. I appreciate that. This is Bloomberg.
With the First Word News, I'm Marissa Gupta. 6 days after that giant container ship got stuck in the Suez Canal, salvage crews had good news to report. The ship's now been partly refloated, and the operation to free it completely is still continuing. Still no word when the canal will be open to traffic. The blockage had led to a backlog of hundreds of ships waiting to pass through. And the Suez Canal isn't the only place where there's a major shipping logjam. Yesterday, a total of 26 container ships were anchored waiting to offload at the twin ports of Los Angeles and Long Beach. Another 20 are expected to arrive over the next 3 days. The average wait for dock space is about 8 days. The ports have a shortage of labor and equipment needed to handle a wave of imports. In Minneapolis today, opening arguments are set in the trial of the former police officer accused in the death of George Floyd. Derek Chauvin was seen in a videotape kneeling on Floyd's neck for more than 9 minutes last May. Floyd's death sparked protests across the U.S. England is taking a much-anticipated step towards exiting its own lockdown. Starting today, 6 people or 2 households can gather outdoors. Plus, outdoor sports facilities like tennis and basketball courts will be allowed to reopen. The government hopes that all lockdown curbs will be lifted by June 21st. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
White House made a really smart move by saying, look, we'd like to see it by May 1st, giving states time, but also sending the message, we really need you to scale up. This supply is going to be there. Don't act surprised when suddenly you have so much vaccine that you really need to open up.
Joshua Sharfstein there, Johns Hopkins Bloomberg School of Public Health Vice Dean, weighing in on what we need to see across this nation as state after state widens out eligibility to receive the vaccine after we saw a number north of 3 million on Friday. The average over the last 7 days, the daily average, 2.71 million, according to our Bloomberg vaccine tracker. Alongside Tom Keene this morning, I'm Jonathan Ferro. Lisa Abramowitz will be back with us tomorrow. Here's the price action this Monday morning. We look like this on the S&P 500. Futures come in 0.4%, down around about 16 points on the S&P 500. There is a bit in the bond market. Yields are down 3 basis points. There is a defensive posture, so to speak, cross-asset with the euro weaker too. Euro dollar at 117.77. We come down about 1/10%, Tom. The main story still, that hedge fund, if we can call it that, the family office of Bill Hwang, let's call it the investment firm of Mr. Hwang, Tom. Forced liquidations of up to $20 billion, and still we're trying to grapple with what's left, how much more still needs to be liquidated and unwound.
You nailed a nuance, John, that we haven't talked about. We'll do that particularly in the 8 o'clock hour, and that is the distinction between a hedge fund and running yourself a family office. These are little nuances of this story, which I'm sure will come out with longer form journalism in the coming days. Right now is without question the most important interview of the day, if not the week, on the fears you or your family have about this pandemic, because those fears are not in America. They are abroad with real virulence and failure in certain nations. Brazil leads the way. That's my amateur opinion. And Albert Coe of the Yale School of Medicine is truly the nation's expert on the challenges of Brazil. He joins us this morning. Dr. Coe, you have spent months and months and months in the epidemiology of Brazil. Why have they failed?
Well, thank you very much, Tom, for having me back on. Yeah, so I think Brazil is really the cautionary tale of having limited vaccine supplies, poor governance with respect to implementing what we know works in public health prevention, and then the spread of a highly transmissible and likely highly virulent variant that initiated in the Amazon, in the city of Manaus, and now has affected most urban centers, major urban centers throughout the country.
Can that variant travel to America? And do we have a system that could defend against the virulence of that variant?
Yeah, so the problem is, Tom, that it's already here. We have identified this is what we call the P1 variant that was first identified in Brazil. It's here in several states in the country, and it's likely there's probably likely community transmission of this strain. With respect to the virulence, the bottom line on this is stopping transmission. The step before it infects people and then causes these severe disease outcomes like hospitalizations and deaths.
You say it's already here, Professor. Have we done enough work on sequencing in America to understand how widespread it actually is?
Yeah, so this is getting widely ramped up. It's throughout the country, the CDC is starting to invest heavily. We're behind the game compared to what other countries. I think the paradigm has really been set by the UK with respect to their genomic surveillance system and picking up these variants. The big problem now is that we know these variants are here, and it's kind of almost magical thinking to think that to believe that we're not going to go through what's happened first in the UK and now much of Europe or in places like Brazil with these variants.
The stress point clearly, though, hospitalizations, Professor, and that trend, as far as I can see, is really decent as vaccinations in this country just carry on ramping up. Away from the sequencing, away from the mutations, when you actually look at the data that matters, which is, are we overwhelming the healthcare system? Are we still heading predominantly in the right direction?
So, Jonathan, that's a good point, an important point. The United States with ramping up and rolling out its vaccinations at a fast pace. I think we're up to almost 28% of the entire population. And I think more importantly is that we've focused that vaccination on the people who are most at risk for dying. and being hospitalized by this disease. These are the elderly and those in the nursing home community. So certainly that's going to help with respect to hospitalizations and deaths. But we are worried about cases and transmission, and we're worried about pockets of people in populations that are not getting vaccinated and not have that protective effect against prevention of those severe outcomes that we really worry about.
Okay. You wander in to do Leninger's biochemistry undergraduate at Yale, and you got a classroom of cherubs that are in awe of Albert Coe. Somebody raises their hand and says, when do I get vaccinated? When do the cherubs studying Leninger cover to cover get vaccinated?
Okay, so you know, as you know, most states in the United States are rapidly opening up to all population groups. So the answer to that question is a very easy one, Tom. It's as soon as possible. This is really a race against time. We want to decrease transmission, you know, in the community. So, and
okay, I don't mean to interrupt, Dr. Kolb. I don't need a time of day. I don't even need to know if it's a Wednesday or a Thursday. Which month are we talking about?
Okay, so most states are going to be opening up in April right now. You know, certainly with the recommendations of the Biden administration to ramp up as soon as possible. So that's April and May. Those are people above 16 years of age. The group that we are particularly concerned about are those less than 16 years of age, because the vaccine has not been authorized as of yet to be used in those populations. And in order to really make a in this epidemic, we're going to have to vaccinate everyone, including the children. So that may not happen until this summer.
Professor, if you think we've got acceptance issues right now in the adult population, what are you anticipating when it comes to people making that decision for their kids?
Yeah, I think so. So again, I think there's a lot of good news. One is that people are being encouraged by the success of the rollout of the vaccine campaign. Second of all, as millions and tens of millions of people are vaccinated, we're seeing that this is, you know, confirming everything that we found from clinical trials, that this is a safe and effective vaccine. And we're seeing, as you mentioned, Jonathan, before, the real dent in hospitalizations. So those are all the good news. And, you know, and we can see from polls and surveys that more and more, you know, each month we're seeing increases in vaccine acceptability throughout the population, and also with respect to vaccinating their children if the vaccine is shown as safe and effective.
Albert, it's always good to hear from you, sir. Come back soon. Albert Coe there, Yale School of Medicine Department Chair and Professor of Epidemiology and of Medicine as well. And Tom, that conversation around the kids getting vaccinated, let me ask you, making the decision in the adult population, we're talking about acceptance issues. What about in the child population, the adults that have to make that decision for their kids?
Well, we've done that before. I mean, that goes back to the 1950s. Frankly, it goes back to John Adams. I mean, you know, 200 years ago.
Coming up,
that decision.
Matt Brill, Invesco Head and North American Investment Graded Senior Portfolio Manager.
I can't get used to you without a tie.
Heard on Bloomberg Radio, seen on TV. You know. This is Bloomberg.
Just COVID, but it's COVID related, but it's also stress related to job. I think COVID probably just sort of was the nail in the coffin for a lot of us. the destruction room here is also a very healthy outlet. I do not encourage it as something that we do on a regular basis, but I do find that when people come in, being able to break plates, being able to write out whatever's on their mind and letting it go, being able to just take out their frustration and their anger.
We're thankful to be able to come to a place like this and be able to break some stuff and release some tension without going to jail.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Conscious of the fact that the vaccine alone and the COVID story alone does not tell the whole story.
We need to get the economy to recover. We need to get the economy to heal with minimal scarring.
The downside, of course, is higher interest rates, higher inflation, and that's really taking some of the steam and froth out of markets.
People are pricing in success for the Fed in terms of achieving the inflation target.
If we do start to see inflation rise in the United States, there's a very good chance that could be exported elsewhere as well.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast on radio and television, and a Monday simulcast different than others. Yes, we'll talk about the boom economy into the jobs report. Good Friday. I will be here for you on Friday when we see what is expected, maybe 1 million jobs formed. John, all pushed aside by a margin call, and it's not a movie.
And so much space for speculation this morning. Let's stick to what we know and what we're hearing from the banks. Credit Suisse involved in all of this say we are in the process of exiting positions. That was as 1 a.m. Eastern time, Tom. So they were still in the process of exiting these positions and still can't tell us, still premature, according to them, to quantify the exact size of the loss. There is still so much we don't know this morning.
Well, there's so much this morning that we don't know, and what it comes down to simply is a set of banks, Nomura, Credit Suisse, Goldman. We have not heard from Morgan Stanley yet, John, and I guess we presume, John, there'll be a further unwind this morning.
I think you can make that assumption. We saw some details of that a little bit earlier this morning, though, Tom. The questions we have to ask and still haven't been answered, I think, come back to the banks. Who handled this well, who didn't?
I totally agree.
Is it just the exposure? Why Goldman and Morgan Stanley are coming off a little bit more lightly this morning compared to, say, Nomura or Credit Suisse, or something about the way they handled it? And I keep returning to this question because I find it fascinating. What is it about Nomura and Credit Suisse that they didn't do? And not just about the exposure they had to Bill Hwang's investment firm.
Involving billions of dollars of loss, dipping into profits for all of this year, maybe more. We've got a great lineup in this hour on radio and television. Tracy Alloway will join us in moments. Her article this morning is definitive on the derivative strategies. Sri Natarajan has worked tirelessly through the weekend, and particularly a focus on Goldman Sachs. And moments ago, Michael Nathanson will join us on the media companies, the failure of the streaming model. It's been a boom, 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 but Paramount Plus brought down Viacom and CBS on that, and we'll have that through this entire hour. John, let's do the markets here, and we really need to emphasize the markets show stability.
Stability. Look, a defensive posture, sure, but stable. Equity futures are down what right now? We're off by 17 points and off by 0.4%. The bond market's bid, yeah, the long end, bull flatter, yields in 3 basis points, 164.61. Tom, you mentioned the analyst community, the team at Moffett-Nathanson. Can you imagine being an analyst trying to cover these names right now? And a lot of people get snarky and say they're just marking to market. If you're marking to market, what's been going on in this market? Certainly not a story attached to fundamentals. It's been a massive story of leverage, just actually sending these names surging, Tom. And then we all spend a lot of time trying to have these elegant narratives around these stories off the back of these huge surges, and then you find out what was actually behind the move to begin with. A huge amount of leverage.
John, I just put out on Twitter the definitive story of this morning, particularly for our global Wall Street audience. Tracy Alloway Behu and Sofia Jorge-Acosta with the definitive article on the derivative strategies that have led to this margin call. Ms. Alloway joins us right now, Bloomberg Markets managing editor. Down at the bottom, Tracy, of your article, you remind us that in 2008, financial Ireland almost collapsed over a margin call, a busted derivative strategy. Is there any sense in this 2021 of the Irish agony of 2008?
Well, I think you and Jonathan just laid out the scene pretty well there. So far, we haven't seen signs that this is really unnerving the wider market. Most investors seem to be taking it in stride. I guess the question is, when you're looking at these kind of interlinkages in the financial system, like there are going to be more losses, right? We think there's more exposure out there. And then the question is, why did the prime brokers have this different reaction? So Jonathan alluded to that. You know, Nomura and Credit Suisse are saying that they have losses. Morgan Stanley hasn't said anything. Goldman seems to have managed it quite well. What did the prime brokers do differently that resulted in all these different, results?
Tracy, is it still too early to tell about the way they've handled this? Is it still too early to draw any conclusions?
I think that's right. I mean, one of the big outcomes of this might be additional scrutiny on derivatives deployed by hedge funds and institutional investors. So this was a family office that seems to have built up these huge positions. We're talking billions of dollars worth of total return swaps and contracts for difference. But no one seemed to have really known about it or connected the dots, certainly not the prime brokers. Most hedge funds are required to disclose their holdings if they're actually buying the stock. But if you're doing it through derivatives, it's basically a loophole that allows you to get tons of exposure without having to declare it. And so the question, I think, for regulators is going to be, how endemic is this in the financial system? And is there a possibility that it can be a disturbing force on the wider market? And of course, we've seen additional scrutiny on hedge funds already because of the Robinhood and GameStop scenario. So this is another unflattering spotlight cast on hedge funds / family offices.
Tracy, from your perspective so far, and I ask this in a way that gives you enough room just to say I simply don't know, but from what you're looking at the moment, do you find it strange about the amount of rope, so to speak, that this particular investment firm was given by prime brokers?
Well, there is a question about risk management here. It seems to have been very, very large positions, and again, possibly positions in single stocks. So there's a sort of whale effect there. The other question is, Bill Hwang, of course, is famous for insider trading. I think back in 2012 or 2014, I want to say. It was a long time since then, but lots of people are asking why the prime brokers felt comfortable extending this kind of financing.
I mean, Tracy, I know that you've done interviews with Bobby Axelrod before of Billions, and it's all great and fine, but you make the distinction between Billions as entertainment, hedge funds, and a family office. Did this occur because a family office is different, that there isn't more of a community that can brace itself and break against too much leverage? Is what we're really talking about one guy made this happen?
I mean, I think there's a point to be made there, but ultimately a family office isn't that different to a hedge fund, right?
Okay.
But there is a question, yeah. Oh, sorry, go ahead.
No, it's just...
Oh, Tracy, he just does that. You know how it works, Tracy. Tom just jumps in and says things, and you've just got to carry on talking.
No, just keep on talking, Tracy. You're allowed to be rude. Wait, I was rude.
A family office is fairly identical to a hedge fund. It's just that it can't really take outside capital. So the disclosure requirements, that regulators are going to be looking at, the idea that it acted by itself, I'm not too sure about that.
Okay.
I mean, what is true is that you have this big fund that seems to have all these interconnections with the rest of the market.
Tracy Alloway, it's good to see you, as always. Bloomberg Markets Managing Editor. And Tom, here's this for me. And, Tracy and I, we've talked for years about particular things in markets. That's one of the smartest, sharpest minds in journalism on these issues. And Tom, what stands out there is still how much we still don't know about what's happened here. And it's going to take a long time to find out.
Well, it's going to take time to find out, and maybe to lunch. I mean, the Sunday headline of Morgan Stanley with a block trade available on a Sunday of Viacom. I've never seen that, John.
Tom, this is the story at the moment, the story over the long term. This is what we've got to do this morning, guys. This morning it's about Bill Hwang. It's about his investment fund blowing up. Tomorrow, Friday, we'll be talking about vaccinations. Beyond that, we'll be talking about the data. The data is set to be stellar for months and months and months. That's where I want to focus right now with Matt Brill of Invesco. Matt, north of 3 million vaccinations in America on Friday, last Friday. This Friday, payrolls could be north of 500,000, maybe approaching 1 million. What does all that mean to you?
Yeah, good morning. To me, it means that we're right on pace to have a really terrific summer in terms of economic activity. So here in my state, Georgia, you now have everybody 16 years and up is eligible to get the vaccine. Just about everybody I know has gotten at least one shot. So I think we're about 4 to 6 weeks away from just this economy just completely reopening and taking off.
Do you assume investment grade price goes down and yield goes up?
Well, over the near term, I think that's likely, yes. So credit spreads, I think, will be going tighter, meaning that the risk of owning corporate bonds will be less going forward. But I do think once these economic prints start to hit this summer or late spring, I think the market's going to react negatively to them, and that will drive up interest rates in the near term. So I think near-term total returns will be challenged.
Well, then what do you do? I mean, this came up many, many times over last week. What do you do with that phrase? I mean, how do you manage that?
Yeah, so you got to kind of play it on the edge as best you can. And some of the things that we're looking at, we have 3 major themes, which are reopening, reflation, and re-rating. So reopening credits, things like travel, leisure, those are going to do quite well. And we think you can get positive total returns there as these companies will specifically benefit from travel and leisure activities picking up this summer. You also have things like re-rating. So high yield bonds that are going to be rated to investment grade within a short period of time. Those are going to have positive total returns. Those can have tremendous chance for upside as well. And then last is reflation. So reflation, just anything commodity related, countries and EM countries that are commodity rich should do well here also. So there are pockets that we think will have positive total returns, but the overall generic beta market is going to struggle over the near term.
Matt, thank you. And our apologies, it's short, but as you know, I'm trying to keep you out of trouble. There's someone at Invesco that probably doesn't want you talking about Archegos this morning. Matt Brill, Invesco head of US Investment Grade and Senior Portfolio Manager, Tom.
Yeah, well, that's great. And Tracy Alloway to come to us, and we've got some other guests coming up here that'll be quite good. Michael Nathanson on actually the media stocks part of this story.
Yeah.
But, John, we haven't really talked about the China exposure from the Tiger Asia guy. I mean, the fact is his legacy is Asia investment, and that seems to be that pullback that we saw in China really got in the way of his strategy.
And the insider trading that Tracy alluded to there back in 2012 around Chinese banks, if my my recollection is correct, Tom, is the reason this became a family office too.
John, it's hard to have a recollection when you have no tie on.
I know.
Did you see the beard rating that we're up to?
Where are we on the beard rating?
We're way up. It's like 13,000.
What's management
something? Management, well, keep the beard 13,000. For those of you on radio,
right here. When that
lose the
goes,
beard,
this comes back. One for lose the beard.
Yeah,
really?
it's from New Jersey.
Is this your lobby effort? Are you lobbying management? You'll get the Bloomberg surveillance equivalent of the tap on the shoulder. Won't be a margin call. Here's a razor. Shave. Coming up, Stephen Schork, the Schork Report founder and editor. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. It's the first step towards reopening the Suez Canal. The giant container ship that has been blocking the water has been partly refloated. The operation to free it completely is still going on. There's still no clarity on when traffic in the canal can resume. There's a backlog of hundreds of ships. President Biden will divide his next government spending push into two programs. The president will outline a plan focused on infrastructure and jobs this week. A White House spokeswoman says the second proposal would focus on childcare and healthcare programs. That will be released in April. In Myanmar, it was the deadliest weekend yet since the military coup in February. Dozens of protesters were killed in battles with the military and the police. One human rights group says at least 114 people died on Saturday, including some who weren't even taking part in the demonstrations, and that's drawn condemnation from governments around the world. And it's a sign of how cryptocurrencies and blockchain technology gain more acceptance in the financial system. Visa's payments networks will use a stablecoin backed by the US dollar to settle transactions. Visa says the move is partly an effort to serve financial technology companies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds of a global economic recovery.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
a little bit earlier than what we had expected. It seemed that the ship had been stuck on both ends, and indeed they've been able to move it, but it's a little bit too early to see when the canal is going to be cleared. So it's one thing to refloat the ship, it's another thing to completely clear the canal for traffic.
Partly refloated. That's the story this morning. Hugo de Stoop, the Euronav CEO from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowitz back with us tomorrow. Looking forward to catching up with Lisa after a really choppy end to the week last week and a really interesting morning this morning. A wave of selling, a mystery seller, no longer a mystery. Bill Huang's investment firm.
Yeah.
Here's the price action, Tom. Can I get to it? Or do you want to say something?
Well, I was just going to say we've been gloom-free. I mean, we're sort of like shocking today how gloom-free we've been on radio and TV.
I'm talking slowly and giving you some space to jump in because you always do. We're down 16. We're off by 0.4%. In the bond market, bonds bid, yields lower by 3 basis points at 164.78. In the FX market, I'll keep this brief. Euro weaker, 117 handle 2. Still to the bond market we go. Tom, yields in. The euro weaker. Into commodities, crude up by 1%, $61.60. I've got to say, yeah, defensive a little bit, but nothing radical, nothing crazy.
VIX 19.92 is actually coming a little bit off the sloppiness of the early morning trading. John, we're waiting on headlines. What are you waiting for, John, right now on this margin call debacle?
I think what you're waiting for too, Tom, just the Morgan Stanley take.
Yeah.
We've heard from the likes of Nomura, the likes of Credit Suisse, and it doesn't look pretty for them if you're looking at this stock price reaction, but the Morgan Stanley take. And then as time goes by, I think we get a deeper understanding of how the likes of Morgan Stanley and Goldman handled this situation in ways that maybe Nomura and Credit Suisse didn't. And beyond that also, here's an individual that got done for insider trading back in 2012, an individual that couldn't pass compliance at Goldman Sachs for a long, long time. And as our colleagues Eric Schatzker and Sri Natarajan have been pointing out in their reporting, something changed in 2018 where this client was taken on board, and here we are.
Mr. Natarajan to join us here in about 15 minutes. Right now on Suez, in our assumptions of hydrocarbons, is Stephen Schork of the Schork Report. He writes a hyper-detailed inside baseball hydrocarbon report. I don't understand 2/3 of it, but I do understand that Stephen Schork is encyclopedic on how oil moves around this world. How open seas, Steve Schork, are our open seas right now when we see Suez shut down or the tensions of the South China Sea?
Yeah, absolutely, Tom, and it's great to be here. Thank you. And indeed, with what we're looking at with Suez, we're talking about 1/10 of the global trade in seaborne oil transits through the Suez Canal. A good deal of that oil coming out of the Middle East, Saudi Arabia, Kuwait, so forth, going to markets in Europe and in the United States. So with the blockage, some I understand are poo-pooing it. They're saying it's only 10%. It's a de minimis amount relative to the global trade. I will disagree. So the question now is that in a market that is as tightly traded as oil, any sort of disruption, let alone 1 every 10 barrels, is not insignificant.
Compare and contrast the South China Sea wrapping around the Straits of Malacca and up north of the Pacific Rim with Suez Canal.
Yeah, these are significantly, those 2 points, they're very narrow waterways and they're global trade routes, and they're 2 of the most important potential choke points for the global trade, not just in oil, but of course in all commodities. And I think that is really the story here when it comes to oil, whether it's Suez or South China Sea. South China Sea, Straits of Malacca, of course, is extremely important because all of your demand growth for oil and for consumer goods is primarily being driven by Asia. So to that standpoint, while the headline of Suez and so forth is a supply side story, the overarching story in the oil market has been and will continue to be for the foreseeable future on the demand side. And this is where the issue really persists because we've got a bifurcated demand scenario. Here in the United States, the macroeconomic headlines we've been seeing have been very positive. Now, keep in mind that over the next month, when we get the ice storms and the debacle that we saw in the mid-continent in the power markets last month, That's going to factor into the next batch of numbers. But overall, that's a one-off event. And the general trend is extremely positive for demand here in the U.S. And that's a great story, and it's bullish for commodities. On the other hand, you have the kind of sloppy rollout of vaccinations in Europe. You have parts of the European economy once again shutting down, the fear of that contagion spreading. So regardless of the supply situation will be fixed. In the foreseeable future. The big question now remains on the demand side.
Stephen, I hope you can indulge me just a little bit. When it comes to commodities and oil, we're talking about tankers going through the Suez. Can we talk about container shipping just for a moment? I hope you could just weigh in on this because I think it's so important. Beyond what's happened in the last couple of weeks, what we saw coming into the new year was container shipping costs absolutely go through the roof. We've seen the same with air freight as well. Clearly, there was a massive demand slump 12 months ago, then a huge inventory rebuild and increased demand off the back of that. In your mind, Stephen, how long does it take to work out some of these kinks in the supply chain, work out some of this demand to be met with supply in the months to come?
Yeah, absolutely, Jonathan. And to your point, the numbers that we're seeing out of data being kept by the Federal Reserve Bank of St. Louis with regard to your point, air freight travel and shipping channels. I mean, the amount of goods being shipped on U.S. waterways, on U.S. flagged barges is surging right now. And again, this goes to my thesis of a very strong demand picture here in the United States. But to your point, demand is strong, but there's only so much of an ability of capacity to move these cargoes. For instance, when we look at the ports of Long Beach and Los Angeles in Southern California, those are the two largest container points for TEUs. TEUs are 20-foot equivalent units. Basically, those are the metal boxes that you see on top of the Evergreen ship stuck in the Suez. That is a picture or a snapshot of the global trade. And when we look at these numbers, and these numbers are very important here in the United States in the months of July and August, because that's all the goods coming into the ports of Southern California coming from Asia. And this is always a great bellwether for retail demand in the fourth quarter going into the holidays. And so when we look at these numbers, we've been smashing numbers with the container flows coming into the United States beginning last summer. And those flows continue to the point where we have containers now, hundreds of containers now anchored off the coast of Southern California because there's no room in the inn. So to answer your question, while we've already been at this for going on 9 months at this point, and there's no sight as to when this is going to end. So we've been in it for 9 months. I'm going to double it. I'll say at least another 9 months before we can clear up this glut.
Stephen, great to catch up and really important detail there. Stephen Schork there, the Schork Report founder and editor. Tom, it's not just about the demand for freight that's sending the cost of freight higher. It's the traffic at the ports. And that's what Stephen was alluding to there, just backing up. That was
a big topic out in Los Angeles this last week. I mean, you know, Long Beach isn't that far from that Motel 6 by LAX. And in Long Beach, it's really, really serious. John, we got Deutsche Bank headlines. Mr. Saving gets an extension of his deal coming in early 2018. It's sort of been round trip. I'm going to call it 11 to 6, and the stock elevating up to 10 today, even margin call adjusted.
An extension to 2026 and appointing Fabrizio Campelli as the head of the investment bank. Tom, interesting that Deutsche Bank, yes, part of this story this morning, but not the big bank in focus this morning. And I imagine for Deutsche Bank and the people who work there, that's somewhat refreshing.
Yeah, well, we'll see. We'll have much more on us. We've got a terrific half hour coming up on this debacle, this margin call.
This is Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
City, this is Bloomberg Surveillance for our audience worldwide, live on TV and radio, alongside Tom Keane. I'm Jonathan Ferro. It's a day for calm, just to drain the drama just a little bit from what's happened through Friday into Monday. Equities are down by a mere 0.5% on the S&P 500. The Nasdaq in by about 0.1%. The Russell off by 0.75%. We did end up with a week of gains last week, and maybe you can thank Bill Hwang's investment firm for that, because it wasn't just about the longs that had to be covered. It was some of the shorts as well, and a lot of people just saying, you know what, maybe that was what that big ramp into the close was on Friday. We'll touch on that in a moment. Switch up the board. Here's the cheat guide to the banks this morning, and it's far more complex than I'm about to make it out to be. But when you get a statement from a bank, look for the word material, and then look for the words before it. If they say maybe material, this is what happens. We're down 15% on Credit Suisse, on Nomura, off by 16%. If they say not material, or allude to the idea that maybe it's not material, you get some relative stability. Switch up the board to the US banks we go. Goldman, Morgan Stanley. Goldman off by 2.5%. Morgan Stanley still waiting for some clarity there, down by a little more than 4%. And that's the unknown, Tom. How this has been handled, the exposure, and what's left to unwind.
That's an important board, staying on 2% down versus 4% down. John, just because of the guests that we've got, let's say, are you done, John? I mean,
I'm done.
You're done? Okay, I noticed renminbi.
You have permission to continue.
No, but you know, we're making it up as we go on this crazy Monday. 6.56 on renminbi, a little bit of foreign exchange movement. What we're going to do in this half hour is Sri Natarajan's going to join us, and then David Kelly of JP Morgan. He will not talk about margin calls, and then we're thrilled to bring you Michael Nathanson on the backside of this half hour. Mr. Natarajan has led our coverage through this weekend, this historic weekend, with a particular eye to Goldman Sachs. Sri, what can you report this morning about what Goldman Sachs and Morgan Stanley are doing? Okay, we just had a technical difficulty with Sri.
Sri knew what was coming.
You know, Sri just hung up the phone and said, I don't want to talk to them. We'll get Sri back on. But, John, this is important, is what does the management of Goldman Sachs and particularly Morgan Stanley do to mitigate risk?
So a lot of people waking up this morning and saying, yeah, sure, I remember Bill Hwang. A lot of other people saying, I've got no idea who that individual is. So let's start there, Tom. Bill Hwang, formerly of a big firm that we all used to be very familiar with, set off on his own once upon a time, and then got done for insider trading in 2012 around a Chinese banks issue. So started to have what's called a family office, which basically translates as, Tom, we're a hedge fund, but we don't take outside money. We're an investment firm, so to speak. And he put on a series of big bets with a lot of leverage. And there was a lot of demand to have him as a client. Why, Tom? Because you made a lot of money having Bill Hwang and his investment firm as a client. Goldman Sachs, well, there's some people at Goldman that clearly wanted Bill Hwang as a client, and compliance, according to our reporting at Goldman, for a series of years, Tom, said no, no, no. Then all of a sudden in 2018, boom, something changed.
There it was.
And Sri's reporting leading us to this idea that all of a sudden Bill Hwang became a client. So we need to talk about what's happened with this, the forced unwinding, what it means for markets, what it could mean for regulation. We also, Tom, need to talk about clients and knowing your customer and compliance.
Sri Natarajan with us now. I believe we're hooked up again. Sri, what are the managements of Goldman Sachs and Morgan Stanley? What are they doing right now? What are they doing this Monday morning?
Well, you can rest assured at this stage, the management at Goldman Sachs is definitely breathing a big sigh of relief. They did telling a lot of their clients that their losses are going to be immaterial. That is, of course, very different from the headlines we have seen coming out of places like Nomura and Credit Suisse. Morgan Stanley has been uncharacteristically quiet, but that's not a strategy that's going to work when everyone from investors to regulators will be demanding answers to get to the bottom of what really happened here.
Sri, do you look at a family office the same as a hedge fund? Did this margin call occur because actually Mr. Wang's shop is a family office, maybe more private, maybe more separate from the compliance and regulation of hedge funds?
It really is a nomenclature mismatch, isn't it, Tom? We're talking about a family office in this case, which, if all the chatter right now is to be believed, had already got a few billion leverage it was employing. It was a serious force in the market, much bigger than several large hedge funds out there. So for the banks on the other side, dealing with this firm, they couldn't possibly be treating it any different. For them, it has to be just as important as their most important hedge fund client, and yet this blow-up that has unraveled in breathtaking speed tells you that not all the boxes were checked properly.
Sri, tremendous reporting, as always. A little bit of a technical issue with your lines. We're letting you run, but for anyone that's not familiar with Sri's reporting, check it out this morning alongside Eric Schatzker on what has happened with Goldman, this particular client over the last several years. Just tremendous clarity, some transparency there that we otherwise wouldn't have, Tom, about what happened, the courting of Bill Hwang as a client, why he was rejected by compliance at Goldman for a number of times, presumably over a series of years, Tom, and then all of a sudden, click, snap, something changed.
Oh, something changed, and we're continuing our reporting through this morning. Two wonderful articles out, the Schatzker Natarajan article and Tracy Alloway with another one. I would notice, John, that futures deteriorate ever so slightly. We're really following it tick by tick with a little weight to the tape right now. Away from the story, David Kelly will join us. He's with JP Morgan Asset Management as their chief global strategist. He wouldn't know a derivative strategy if it hit him over the head, so he's lucky this morning he doesn't have to talk about this. What you can talk about, David, that is so important is, given a boom economy, how your allocation, how your temperament at JP Morgan Asset Management changes. How do you adapt to a boom economy?
Well, I think the first thing is you recognize that people have not fully priced in what's going on here. I mean, this is the calm before the surge. We're still looking at about 4% GDP growth in the first quarter, nothing terribly exciting going on. But what we're seeing is this rollout of vaccines. We're seeing this rollout of fiscal stimulus. You've got the president about to announce another proposal this week in Pittsburgh. And this is going to build to a lot of momentum as this year goes on. So I think the environment is going to heat up a lot more than is really priced into markets. That means higher interest rates. And what that really means is the rotation probably continues, the rotation from growth to value, the rotation from large cap growth to small cap value, and perhaps some continued rotation to international. I think all of that is still on the table, given the heating up in the economy that we expect over the next 9 months.
What you just said, I've also heard at BlackRock, David, that maybe this is all underappreciated still, that this data we're about to get is still going to be unexpected to some people. How do you gauge that in this market at the moment?
Well, I think the real point is that people have not seen this before. I mean, we have not seen this magnitude of fiscal stimulus along with a full pandemic recovery. It's completely unknown territory, so I don't think people have a good way of measuring what this is likely to do. But I think the important point is, if you've got all the stimulus, it can only go in one of two places. It's either going to push up real output, or it's going to push up inflation. And either of those, scenarios, does benefit cyclical stocks. It does suggest higher interest rates. So I think one way or the other, we're going to get higher interest rates out of this. And I think that it's just because this is so new and there's still such uncertainty about how an economy recovers from a pandemic. I think that's why people are underappreciating it right now.
David, that's the mystery of what's about to happen in the next couple of months, is how people respond to the data we're about to see. What's your game plan? How do you think people will respond to the data we're about to see? The payrolls print, which could be huge this coming Friday. The inflation print, when the base effects start to kick in this month and next.
Well, obviously, people have to keep an eye on their tax exposure, but if you can rebalance to make sure you're not underweight value, to make sure you're not underweight international, to make sure you're not overweight the most, the highest PE and the most exuberant sectors of the economy, because what we're seeing right now, in the story you're just covering, is to some extent a part of a much broader story, which is if you have a mismatch of lots of exuberance and lots of liquidity, you end up with excess leverage and bad things happen. And you can think of plenty of areas, markets, where people are too exuberant, and that exuberance is being fed by low interest rates, and those low interest rates are going to go away over time. And I think that's what people really need to pay attention to here.
Walk down the income statement, Dr. Kelly. I'm going to get revenue. I'm going to get organic revenue growth like I've never seen before. And into Q2, Q3, Q4, do we get margin compression down the balance sheet, or does revenues just drift away? Which is it?
I think the margin compression comes a little later. I mean, we're going to have such a surge in demand over the second, third, fourth quarters, first quarter of next year. At the same time, I think the Fed has put out this forward guidance which forces them to be, easier than they really should be. And so I think rates will rise, but just a little slower. And particularly because, so many companies have locked in long-term financing, I don't think that squeezes margins too much. And we'll also see wage growth pick up, but again, it's going to take a while. These things lag a bit. So I think the real margin pressure is going to come in 2022, particularly as the economy then slows down again. I mean, what we've got right now is a crawl, then a surge, and then a normalization. It's that normalization later on in 2022, which I think will slow down profit growth. But for right now, profit growth looks extremely strong for this year.
Here's the data point on my dashboard. David, when does David Kelly get back to the office? When does that happen?
I'm thinking middle of summer.
Middle of summer?
Summer what, 2024?
22, 21, 3, 4?
21. I want to get back. To
Very
Manhattan.
good. And we say good morning to Mr. Diamond.
David, thank you. David Kelly, JP Morgan Asset Management Chief Global Strategist. I think that's what Mr. Diamond wants to hear as well, Tom.
Yeah,
he wants his people out on TV, on radio, saying, yeah, we'll be back in the summer.
But it's really a microcosm, John. What I found fascinating in my sabbatical was everything is a story. Everything is one person's story in the pandemic, whether it's a fancy executive or it's an employee deciding bus or subway, whatever. Everything is a micro story, and they've all got to sum up to a recovery.
I love that you're referring it to a sabbatical, your week off. I'm going to be away. I won't be here next week. I've got to put this tie on now for the Open. Can I tease my show just quickly? Can I do that? I'm going to do it anyway.
Please.
BlackRock CIO of Global Fixed Income, Rick Reeder, joining us on Bloomberg TV in the next hour. I will have a tie on for my personal show on Bloomberg Television. My tie will be off tomorrow if Tom Keene still has a beard. What's the latest on that?
Well, the latest on it, John, is, I mean, we really got to pick up here as people wake up across America from sea to shining sea. And it's really good. We've got a substantial number, over 100,000, saying keep the beard, and the lose the beard has been very stable.
Has a guy called Mike weighed in yet? That's the one I'm waiting for.
No, I don't believe that Mike from the Bahamas has weighed in yet. I believe Al from New Jersey
What's Al from New Jersey said?
He's the one. He said lose.
He's the one. He said lose the beard.
We lost the one because on radio, 156,000 people say keep the beard, lose the tie, and Al from New Jersey says maybe not.
We'll find out tomorrow.
Yeah, we will.
From New York City. Good to be back with you, Tom. Good to have you back. S&P 500 futures down 21.
You say
down 0.5%. I mean it. 39.44. Can't give a straight face.
Lisa, come home.
This is Bloomberg.
Lisa, go home.
With the First Word News, I'm Ruchika Gupta. 6 days after that giant container ship got stuck in the Suez Canal, salvage crews had good news to report. The ship's now been partly refloated, and the operation to free it completely is still continuing. Still no word when the canal will be open to traffic. The blockage had led to a backlog of hundreds of ships waiting to pass through. And the Suez Canal isn't the only place where there's a major shipping logjam. Yesterday, a total of 26 container ships were anchored, waiting to offload at the twin ports of Los Angeles and Long Beach. Another 20 are expected to arrive over the next 3 days. The average wait for dock space, about 8 days. The ports have a shortage of labor and equipment needed to handle a wave of imports. In Minneapolis today, opening arguments are set in the trial of the former police officer accused in the death of George Floyd. Derek Chauvin was seen in a videotape kneeling on Floyd's neck for more than 9 minutes last May. Floyd's death sparked protests across the U.S. And H&M stores in some parts of China are being closed by their landlords. It's a backlash to a H&M statement that expressed concern about reports of forced labor in the Xinjiang region. China's is the Swedish retailer's fourth biggest country market. And former Securities and Exchange Commission Chairman Jay Clayton will advise an asset management firm on cryptocurrency. One River Asset Management is a $2.5 billion firm whose cryptocurrency funds are backed by hedge fund titan Alan Howard. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
You see the price action and you wonder, okay, is this fundamentally driven or is this something else? And it seems like this is a big case of that something else.
I think it highlights the risks that people haven't seen on positioning, and it highlights the concentration in the market and also some of the leverage in the market, particularly the hedge funds. So we're going to have to be careful.
I would say if you're, your typical average investor, your retail investor, I would stay out of this for the next couple of days.
some of the voices there, the mystery that's out there right now in this margin call, if you're not a sophisticate on global Wall Street, what you need to know is there is a global tension on global Wall Street this morning over the mysteries of a margin call. Our team has put together a great set of interviews starting with Sunday. We went through the morning. I thought Tracy Alloway of Bloomberg was particularly strong on these complex derivative strategies. We hear there from Brian Jacobson of Wells Fargo, Sean Taylor joins from DWS, and Carol Pepper joins of Pepper International. Let me tell you about the markets right now. As John Farrow has mentioned, there's been some real stability here. Yes, futures decline, -21, Dow futures -186, and the VIX really out to new highs here, 20.49. What we want to do now is take a true industry expert, not on Chinese stocks, but on the media stocks that got hammered, and say, what do you do in this unique time? No one is better qualified than Michael Nathanson with Craig Moffett at MoffettNathanson, and we're thrilled he could join us this morning. What do you do, Mike? I mean, you and I have seen these debacles before, but this is in your backyard. I believe a buy on Viacom. You know, what did you do Friday?
No, we were selling Viacom. We were buying Discovery.
Okay. So, but what do you do this morning?
We buy Discovery, and we don't own Viacom. The companies cannot be more different right now in their positioning. Discovery, we could argue, is cheap right now in current cash flow. Viacom is not. Discovery's got a much easier path going forward than Viacom. And it's funny, the market's treated both the same, but we think that.
Okay, we've lost some audio there with Michael Nathanson, and of course this is an ongoing story, and so much of this, folks, is off streaming. It is off what we saw at Viacom with Paramount Plus. Obviously Viacom and CBS combined it. I know all of you coast to coast have seen a huge marketing effort on Paramount Plus, and it's really up in the air among industry pros whether that streaming service will get that critical mass that you need, like you have at Netflix, like you have at some of the other successful stories. So let's go back to Michael Nathanson now as we reconnect. Michael, I was talking about how SpongeBob over at Viacom CBS did in William Wang. I mean, streaming here is being tested. Up we go with a moonshot and then down. What about streaming in an uptake? Is that what did in William Wang?
Yeah, I think what did it in was the valuation was insane at Viacom. Viacom claimed that they raised capital because they needed more capital to invest in direct-to-consumer, right? So I think one of the things that you and I have talked about over the years is just the capital intensity of this pivot. Very few companies besides Netflix and Disney and Amazon have the balance sheet, have the firepower, the investor base to do this. And I think what Viacom is trying to do is play catch-up in a very difficult business, right? And I think raising capital where they did, and the reasons they gave, which was we need more money for direct consumer spending, that was the beginning of the end, right? And I don't think it recovers. I don't. I think it was overvalued. We put a sell on it on Wednesday. I just think they're in a different place than these other companies.
In a different place. I happened, Michael, to be out in LA over the last week. Instead of going abroad with a pandemic and all, we decided to stay in the country. And you can't help but notice, for your consideration, it's award season. You are the king of content is king. Is content still king?
I think platform has become king, right? Netflix is the ability to surface content that you may never have heard of, but the ability to surface and show you content that others may like and you may like yourself changes the model, right? The best content now, I would argue, doesn't always win. It needs to be surfaced, it needs to be delivered to you, it needs to be packaged on a platform. So again, to your point, if you don't scale globally, you may have wonderful content, but no one's going to discover it.
Tell us about the Asian markets. So much of this margin call debacle is about China. And of course, China, our political story here at Bloomberg Surveillance as well. Is Hollywood still making Nathanson product to sell internationally and particularly to sell to China?
No, what's funny about that is that India has replaced China as the most important market, right? So India is where Disney with Hotstar has done really, really well. Amazon and Netflix are trying to catch up there. China is a place that has always offered, this potential but it's never really delivered, right? The country is very, very good at keeping out and putting limits on American content in China, whereas India is a much more open market and has a great opportunity for the U.S. companies, especially Disney, to do very well there. So I think India is our next key, has been the next key market to watch.
Then how do you play that? What is your single best Indian buy?
That's a good question. Look, we're neutral on Disney. Disney's probably the cleanest. Well, Disney's position, they bought a Fox company called Star and Hotstar that's done very well for them. So I think they have the easiest path of our companies in India. But also, we have buys on Facebook, Snap, and Google for similar reasons, right, Tom? So that's an easy way to play it as well. You just play the digital names that are getting traction in India right now.
Michael Nathanson, thank you so much for joining us on this historic Monday morning. Of course, margin calls to be had as well. Let me tell you what we're going to do through Bloomberg through the morning. Mr. Farrell will drive forward television here with some good conversations scheduled in the 9 o'clock hour. I am thrilled to join you with Paul Sweeney. Look for that here on Bloomberg Radio in a moment. Paul Sweeney, of course, legendary in the media business, and will really be quite good, quite prescient here on what we expect from media and its linkage in to Wall Street. But the headline story, without question, for global Wall Street is a busted set of derivative trades involving Mr. Wang, of course, of Tiger Asia years ago, and now his own family office. Our reporting this morning is simple. There needs to be more reporting. We heard that from Srinath Rajan. We heard that from Tracy Alloway, that we simply don't know too much that will go on this Monday or go on this Tuesday as well. Of course, the key thing for me yesterday, Morgan Stanley making clear on a Sunday that they had a block trade available on Nathanson's Viacom. He has a sell on Viacom. We'll see if that trade unwinds. He made clear to me off camera that he felt they would find a buyer for that large block trade sold at a discount, which becomes attractive to the institutional market. Other than that, it is about the damage to the banks, and we'll have much more on that. We've heard from Nomura. We've heard from Credit Suisse. A little bit we've heard from Goldman Sachs. We'll have to see how that goes. And really critical here in the next couple hours, what will we hear from Mr. Gorman's Morgan Stanley? Futures in negative 21, Dow futures negative 175. Stay with us through the day. This is Bloomberg. Good morning.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A monster margin call from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now. 30 minutes away from the opening bell with equity futures on the S&P 500 down 0.5%. Let's get straight to it. We begin with the big issue. Massive block trades rattling markets.
This is an unwind of a levered position. These events, and we've had them before.
Margin calls, concentrated position, high leverage.
Highly levered, highly concentrated positions.
Less requirement on collateral, less requirement on risk management.
It highlights the concentration in the market.
It means that the risk management of these various parties is inadequate.
That can be a pretty dangerous proposition.
This is very specific.
This is going to be a very small bump in the road.
Leverage in the marketplace is nothing new.
Markets are down in caution.
This will blow over in a couple of days.
But the problem, of course, is that this is the domain of rumors.
It normally takes some time for the bodies to float to the surface.
James Athey at the end there. Let's bring in the Bloomberg team, Kelly Lyons and Shonali Basak. Morning, Kelly.
Good morning, John. Well, traders are bracing themselves as we wait to see what today will bring. Will we see more block trades? Will we see any sign of broader market contagion? Though I would note, ahead of the open, equities aren't looking all too panicked. Yes, we're down when it comes to futures, but only by about 21 points or so on S&P E-minis, while equities shrugged off concerns in the Asian session and were fractionally higher in Europe as well. Where we're seeing more pressure, though, is the banks, with Credit Suisse and Nomura warning of significant losses stemming from a U.S. client. They didn't name Johns, but we know that banks across the world are tallying up the impact of their exposure to Archegos. And when it comes to Nomura, that stock sank a record 16% in Japan overnight, and the company's debt took a hit as well. The spread on Nomura's 2025 dollar bond jumped the most since November. Borrowing costs moving higher after Nomura actually pulled a bond sale that was already priced. Now, there are a number of other companies and equities involved in this as well, John. You had Goldman Sachs and Morgan Stanley executing those block trades on Friday. The stocks getting sold, of course, took massive hits. Viacom, CBS, and Discovery each fell a record 27% in the Friday session. Discovery is fractionally higher, trying to recover in pre-market trading, while Viacom, CBS is still down around 3%, as we're seeing fluctuating gains and losses in some of the Chinese ADRs that were affected as well. Any recovery may be just tentative, John, because there remains a question of whether or not more unwinding is to come, John.
Kelly, thank you. That's the story. A lot of talk this morning about the longs that needed to be sold and not the shorts that needed to be covered. We need to talk about both sides of the book. I'm sure you all saw that massive ramp into the close on Friday where we went vertical, and a lot of people this morning drawing a line between that and this. Beyond that, what don't we know? What's left to unwind? What we do know is this commentary from Credit Suisse this morning, who said we are in the process of exiting positions. In the process, is that process complete? We need to talk about the banks. Here's Shonali Basak for more. Morning, Shonali.
Good morning, John. Yes, that process is something a lot of people have questions about, and the size of Credit Suisse's exposure. Remember, Credit Suisse has losses tied to Greensill as well. It's a big deal for a bank. A big deal for a bank that's been trying to grow its prime brokerage business to this scale. Nomura said the size of its loss would be, or the claim would be about $2 billion. So we know that these losses could be of significant scale, though we know Goldman and Morgan Stanley were able to shed that exposure quite significantly early on. The questions that remain are how much deleveraging do we see from here? We've seen leverage really riding at record highs in recent months. And separately, what does this mean moving forward for how much risk people are willing to take on? Is there fallout not only among the banks, but among other hedge funds as well that are either exposed to these names or facing margin calls of their own?
Shanali, how these banks service this client, point one. And point two, how they handle the fallout. It's very interesting just to compare and contrast the price action we see in Nomura and Credit Suisse to Morgan Stanley and Goldman. And Tom and I have had the conversation all morning. Is it something about the exposure there or something more about how they handled the fallout?
Both probably, right? You had them shed these assets very quickly, but you also have a lot of safety embedded in these banks. They made those margin calls very early on. We don't know the nature of all the contracts that were sold, right? There's a lot of questions around these CFDs or contracts for difference. There are a lot of rules around those in the US. We expect that regulators should be coming out quite quickly, right? This is, and you know, when Gary Gensler takes charge as well, this is really just fertile ground for regulators to be taking a look at. How were these positions able to be amassed with such little disclosure at the end of the day?
The team here at Bloomberg doing a wonderful job of this. Tracy Alloway running up a lot of this stuff, Shanali, and of course your colleague Sri Natarajan doing a lot around the Goldman story. And can we just finish there just briefly, Shanali? Why Goldman Sachs reportedly rejected this client again and again repeatedly. Compliance said no, and then all of a sudden, 2018, something changed. What changed?
That's the big question, John. What changed, right? We've seen firms that have been embroiled in scandals before that have then turned into family offices, and banks then come work with them after some sort of a grace period, right? It's not the same time we've seen somebody rise from the ashes. It's pretty amazing, though, with how much he had bought assets on borrowed funds, right? He was really enabled here by all the banks he worked with.
Shanali, good to catch up. Looking forward to the day two story, the day three, the four, the five. This is going to continue, no doubt. Let's bring in Rick Reeder, BlackRock Global Fixed Income CIO. Rick, you get a free pass. We don't have to talk about any of this with you. We're just going to touch on it briefly. Let me just go there just for a moment. Does this tell you anything about how loaded the boat is to the one side, how much leverage there might be, how little it took to break something, a fund this big?
It does, Jonathan. I mean, listen, there's no lack of news in the world today. I mean, we were dealing with Turkey last week. There's obviously the discussion around the deficit, et cetera. There's no lack of news. But one of the things that's really important is, you know, we've gone through this period of incredibly easy policy. And one of the things that tends to be born out of easy policy, and the longer that policy stays at the table, is you do get leverage that builds up. You do see financings that take place that are questionable. And so I think this is just another derivative impact of the period that we're in right now. So you've got to keep an eye on it. I mean, I run very big equity portfolios as well. And, there's also things you take advantage of when you see these sort of dislocations. So, we were certainly looking at doing some of that, or did some of that on Friday as well.
How do you take advantage of that, Rick? What do you do?
So, there's some of these names that come under pressure, and the market liquidity today is light, and particularly single name, particularly what we call front of the book liquidity. At any point in time, when you're trying to execute at a price, liquidity across markets is not great. I mean, the uncertainty surrounding how's the economy going to grow, the vaccine developments, the size of the deficits, where's the Fed going? There's a lot of uncertainties. So the depth of the book liquidity is pretty light. So the ability to come in on some of these markets, there were some names that are tangential to what was happening here that came under a lot of pressure. And anyway, there were some pretty good buys to be made on Friday. So you try and take advantage of that, and then and obviously got to keep an eye on, is there more of this to come?
I can read between the lines that you did do some of that, Rick. You're basically telling me that. I understand you can't tell me which names you did that with. What I can lean on you, though, for a little bit more information is just how much cash, the cash allocation you would carry right now, just to have in store to take advantage of these kind of situations that maybe you're anticipating to happen again, maybe repeatedly through the year.
So, John, I tell you, there's a balance that you have to strike between how much cash do you run and how do you generate return. We're running I think the highest level of cash we've run in years, maybe ever. And so, the idea being, when rates move higher, the pressure it puts on other asset classes and where the opportunity set is. So we're running a higher level of cash that allows us to take advantage of opportunities like this. I don't think we're done in terms of volatility in markets, given what liquidity is, given the uncertainty that's out there. So we're running a high level of cash in the portfolios. And, you know, when you get some pressures like this, it's worth taking advantage of and trying to put some of that money to work. But listen, I have to say, John, I guess I don't know how many straight months we've talked about, you know, pretty bold up on the equity market and but I think there's some things to take note of. And I think these uncertainties, particularly around the Fed staying a long time, you know, have taken some of the shine off of the equity market. So we brought down a bit of that beta, and I'm probably going to run that way for a bit of time.
Interesting, Rick. Where did you pare down risk? Where did you trim?
So, I mean, it's certainly equity beta. I mean, certainly, you know, the amount of equity exposure in a number of our funds we brought, depending on which funds, you know, we took that down. And, you know, I think the high yield market is also one that, quite frankly, it's just not that interesting anymore. When you move the risk-free rate, not only do you move it higher, but when you get this volatility of the risk-free rate, you know, you increase risk premium in a number of these asset classes. And quite frankly, it's been a pretty good run in places like high yield. And so, you know, we're paring back some of that, but we're still putting money to work. I mean, you know, maybe going up the credit quality spectrum in parts of the investor grade market are actually pretty interesting. So it's we're paring back some beta, running more cash, and taking a bit more of a cautious approach. By the way, this is also a seasonal period. As you get into April to July, you know, if you're not talking about sell in May and go away, there's some realistic dynamic around that. That it's just the liquidity is not as great during this period. There's not as much, you know, upside, I would argue. So anyway, we're going to run a little bit lower risk than we have.
Rick, away from the seasonal issues, what was it on the dashboard that started flashing just a little bit for you that said, now's the right time, this makes sense? Some kind of regime shift, something you think we're entering something new that warranted this?
So it's a great question. So listen, I mean, I think the discussion from the Fed is, you know, I think there needs to be a plan. And I think the Fed needs to start reducing the size of the quantitative easing program. I think they need to, you know, we think about the supply that's going to have to come to the market in 2022. They need to support long-end treasuries. So I think some form of twist, but a plan is going to be important. And then, you know, you're seeing, as you say, and, you know, I don't think people recognize this as much. When you keep rates here for so long, and you have to move off, if you don't move off of that, you think about what's happening in the SPAC market, what's happening in the financing markets, you know, that gives you a bit of pause around, you know, it's a little tougher to get, not more than a little tougher to get deals done. And then, you know, when I think about some of the credit markets, gosh, the levels are not that enticing anymore. You know, all these things start to add up and say, by the way, I still think equities are going higher. And by the way, they've been incredibly resilient through this period. I still think equities can go a bit higher, but boy, I don't know. There's a lot of things that exactly as you described that are flashing on the dashboard that say, you know what, maybe we reduce it a bit.
Rick, this is a really interesting time, and I'm surprised to hear you saying these words, so I'm processing it along with my audience as you talk about what you're doing in this market at the moment. Going forward then, can you help me just get a better understanding of the game plan for the next couple of months? Because you're doing this before we see the 500,000 print, the 1 million print in payrolls that we might see over the next couple of months. You're doing this before we see that push higher in the inflation print as well. What is the game plan for the next couple of months when we start to see that data come through?
So a couple of things. So by the way, it was a little eerie that you even mentioned because I do use dashboards for this, so I'm not sure where you came up with that. But but anyway, we do look at so, you know, part of what we do in these dashboards is we try and forecast where things are moving. And quite frankly, markets have anticipated that you're going to see some pretty significant growth. You could get a big payroll print this week. You could get a big ISM number print this week. I think you will get a strong number this week. But the markets have started to price in that growth. Listen, I think that growth, I think it's going to be much higher than people have said. You know, and I think maybe you'll see more and more economists moving those numbers up. But I still think you're going to get high sevens, and I think you could even eclipse that from a growth point of view. But the markets have started to price that in. And so, you know, our job today is to think about, you know, the S&P 500 pressing 4,000. I don't know, not as exciting as the last few months I've been on with you. So, you know, while the growth I think is going to be tremendous, it'll lift corporate earnings, it'll lift corporate top line revenue. But, you know, tax is going to adjust, corporate tax is going to adjust, personal tax is going to adjust. There's a series of things that, you know, that cause you to say, maybe I need to recalibrate a little bit.
Rick, I'm going to have a lot of follow-up questions after this interview. You know that. I'll reach out soon. Rick, it's good to catch up, sir. Rick Reeder of BlackRock, thank you. Coming up on this program, global virus cases on the rise for a 5th consecutive week as the death toll continues to accelerate. In the United States, though, the numbers have been stellar. Vaccinations in America on Friday, north of 3 million. Your daily average over the last 7 days, 2.71. The outlook in America improves. The outlook with David Leibovitz of JP Morgan Asset Management next. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
What we're likely seeing is because of things like spring break and pulling back on the mitigation methods that you've seen now. Several states have done that. I believe it's premature. When you're coming down from a big peak and you reach a point and start to plateau, once you stay at that plateau, you're really in danger of a surge coming up. And unfortunately, that's what we're starting to see. We've seen that in our own country, and that's exactly what's happened in Europe.
Dr. Fauci raising concerns about easing restrictions too soon as global COVID cases rise for a fifth straight week. In Germany, Chancellor Angela Merkel threatening to assert federal authority to stem infections, saying, quote, "I have a feeling of determination to tackle the third wave of the virus that is confronting us. We are bound by law to contain the infections. Right now, we don't have containment." I want to bring you some breaking news quickly as well. For those of you who've been on ships stuck in canal watch for the last week or so, Suez Canal says the ship is afloat and it is free from the bank. We can talk about that a little bit more a little bit later. I want to catch up with my colleague, Guy Johnson, out of London, on what's happening in Europe and what is happening in the United States. And Guy, I have to say, what is happening in the United States and what is not happening in Europe. The numbers on Friday in America, north of 300 million, more than 300 million vaccinations a day. Just unreal, Guy.
Absolutely, and the compare and contrast does not put Europe in a particularly good light, John. As you mentioned, Angela Merkel talking about federalizing the German response. At the moment, it's being run on a state-by-state basis with a federal umbrella over the top of it. She's talking about federalizing the entire response, bringing it back to Berlin. There's a meeting, we understand, potentially taking place tomorrow with the state leaders. Over in France, where the situation is really dire at the moment, John, ICU patients with COVID in ICUs at the moment are back up or very close to the same level we saw at the peak of the last wave that was back in the fall. France really finding itself in a very, very difficult position at the moment. And again, you then compare and contrast that with what's happening here in the UK. The UK starting to slowly creep out of lockdown, John. That is starting today. You are able to go to a golf course. You are allowed to play team sports. You are allowed to meet in your own garden. Boris Johnson, a press conference at noon Eastern time today, is going to reiterate a very similar line that we got from Anthony Fauci there. Caution is the watchword right now. But yesterday, John, no COVID deaths were reported in London. That's the extent of what is happening here. And it's very interesting to compare and contrast the strategy. The UK, as it started its vaccine program, basically said, you know what, we need to lock down hard. And that is now what continental Europe potentially is looking at it as it try and ramps up its vaccination program. I'll leave you with this thought, John. There is a batch of meningitis vaccine that is being held up in Rome right now. There are reports of this by the customs there because they're worried that the drug makers are trying to sneak vaccines out of Europe at the moment. So they're holding up this batch of GSK meningitis vaccine because they're so worried about what is happening here. And Thierry Breton over the weekend, the commissioner, once again reiterating that the EU could ban vaccine exports, John.
Europe not looking good right now. What a mess this has become, and how quickly this has become a mess. Guy, got to catch up. Looking forward to the coverage. Guy will be joining you in about 40 minutes with Alex Steele. We've got to focus on the good news, not just the bad news. We've been drowning in bad news for the last 12 months. So let's focus on the good news here in America. North of 3 million vaccine today on Friday, a daily record. Your daily average over the last 7 days, 2.71 million, according to the data we track here at Bloomberg. Just great. And if you look at the cities around America right now, if you spent any time at a weekend here in New York City, buzzing. Now, I understand the risks around that. We'll get the medical experts to discuss it. But for this economy, the outlook is brighter, brighter, brighter. And this Friday, the outlook for payrolls growth, your median estimate in and around 650,000. The team at Bank of America looking for 1 million, a 1 million print this coming Friday. And I imagine off the back of some of the data they're tracking on spending, which has just been absolutely terrific here in America as well, off the back of the stimulus payments. That's the conversation we need to have at the moment with JP Morgan's David Leibovitz, seeing more growth ahead and saying the global economy remains resilient. He writes the following: investors are beginning to focus on the expected rebound in consumer spending. The US and UK look set to lead the charge given progress on vaccination, but Europe should only be a few months behind. David joins us now for more. David, is that the face you have in Europe, just a few months behind?
So I think given where things currently stand, it does just look like they are a few months behind in terms of progress on vaccination, but obviously at somewhat of a pivotal point. You just made that comment about what's happening with some of the vaccines that are trying to be shipped out of Italy and looking for signs that maybe COVID vaccines are trying to be moved out of Europe. I think that is certainly a complicated dynamic, and obviously there is the potential for things to deteriorate further here, but our base case view remains that they will get their population vaccinated. I think by the end of the year, the developed world will be in a pretty good place. And so to us, this is more of a temporary disruption to the narrative that was pretty firmly in play at the beginning of this year, rather than a significant about-face.
What does that mean for how you position in this market at the moment, David? Because we've already seen a massive rally in European banks, already seen a massive rally in travel and leisure stocks over in Europe. So how do you position for that?
So I think a big part of the rally that we've seen thus far has really been on the back of a weakening U.S. dollar. And that's obviously something that is increasingly being called into question, given the increase in the spread between bonds and treasuries, given this evolving growth differential that obviously ties back to the vaccine. We still like cyclicality broadly. We still like the idea of having exposure to the reflation trade, but we're becoming a bit more nuanced in how we put that on. And so rather than blindly buying beta, which obviously worked at the beginning of this year, we're starting to have more conversations around U.S. banks versus European banks, U.S. leisure stocks versus European leisure stocks. And I do think that the market is going to become more discriminating here going forward, particularly if you see a lack of forward progress in terms of vaccinations in the Eurozone.
So just to be clear here, David, you expect more regional dispersion across a range of sectors, but you're leaning into Europe more so. Why?
So I think that the key question here is really where do we go and how much further does this trade have to run? Because I think that there's an angle of all of this where if we think about what we might hear from the president later on this week, another surge in U.S. demand on the back of additional fiscal spending could arguably be very good for the rest of the world. And so I do think that there's a chance that you see this broader value trade and this broader global cyclical trade continue to move forward here. But I think it's really investors are positioned for a lot of good news in the back half of this year. And as you were discussing with the prior guest, I think it's really going to be all about how the data comes in relative to where expectations are today. Most people, I think, looking for about 650 or 700,000 on payrolls this Friday. If that 1 million print does materialize, that's going to be more fuel for the fire. But the bottom line here is that if things just come in line with expectations, that's going to undermine further progress from a cyclical perspective.
David, sit tight. You and I will continue this conversation. We'll get Christina Hooper of Invesco to come along and join us too. Coming up on this program, the analyst action you need to know. That'll be next in our morning call, and later, bank stocks slumping ahead of the open as they tally their exposure to wrong way bets by Archegos Capital Management. That conversation still ahead with JP Morgan's David Leibovitz and Invesco's Christina Hooper. This is Bloomberg.
Friday, a Bloomberg Television exclusive, a conversation with Baidu co-founder and CEO Robin Li.
We're far from done. We will continue to invest for the next 10, 20 years.
Watch the full interview only on Bloomberg Television.
Five minutes away from the opening bell in New York City this morning. Good morning. Equities down 21 on the S&P. We're negative about 0.5%. No drama to kick things off this Monday morning. Let's get you some morning calls. I'll look at some of the analyst recommendations on Wall Street this morning. We begin first up with Bank of America downgrading Credit Suisse to neutral from buy. The analyst citing losses from the Archegos liquidator and saying he sees, quote, extensive rebounding ahead. Next up, Jefferies raising its price target on General Motors to 62 from 50. The analysts seeing opportunity for the company to climb higher as it makes the transition to electric vehicles. And your third call comes from Barclays, boosting its price target on shares of Fox to 38 from 29. The analyst citing the value of companies' potential in sports betting and iGaming amid more legalization. That stock is firmer by 1.3%. Coming up, margin call, the fallout hitting the big banks ahead of the open. That conversation up next with JP Morgan's David Leibovitz and Invesco's Christina Hooper. This is Bloomberg.